Hello, my CMA Final friends. As promised, we are coming up with a extensive MCQ practice. I am your anchor friend, CMA Prasad Bhat, and let's start our MCQ practice. So, what we are going to do is we are going to solve each and every MCQ from 2022. Okay, so we'll start with the year 2022, then 2023, 24, and 25. So all the papers of SFM, each and every MCQ which is asked, we are going to solve it step by step. Okay, so this will help us in two things. One is how to solve the MCQ, what is the method used, if there is any shortcut method, then what is the shortcut method, and while we are solving the MCQ, we will also discuss the concepts. Okay, so MCQ, yes, along with concepts, perfect. Okay, so let us start with the year 2022. Okay, so let us start with the year that is December of 2022. So every question, this is the question paper. We all know that the question paper is colorful. Okay, and the moment a student sees the paper, the student goes colorless. So we don't want that to happen. We want your result also should be colorful and happy. And therefore, we are doing this practice of MCQs. Okay, let us start. Okay. So the first question they are asking, first question is the initial outflow of a company is rupees 10 lakh and it will generate a cash outflow of 3,40,000. Life is 4 years. Cost of capital is 5%. And by how much by annual cash flows before the company, the project becomes indifferent. Okay, the project becomes indifferent. So indifferent means it doesn't matter. So now we know, now since the data is given, we understand that this is a question based on capital budgeting, that is capital investment planning, and they are asking us that what should be, okay, how much can be the cash inflows. We want to calculate the cash inflows which will make the project indifferent. In simple language, they want us to find out the sensitivity. We learned the concept of sensitivity, that if the NPV becomes negative, we reject the project. We know that if the NPV is positive, we accept the project. So what do they mean here by the indifference? It means that what will be the cash flows, inflows, where NPV becomes zero. That is what we have to find. Okay, so first thing when you read a question is we need to understand what they want us to find out. So we have to give some time in reading the language. So here the keyword is indifferent. That is the keyword. So when do you or when are you indifferent? When NPV becomes zero. Okay, so once we understand this, then the calculation becomes easy. So what is the formula of NPV? Formula of NPV is present value of inflows minus present value of outflows. That is the investment part. And present value factor is already given, 5% 4 years. That data is already available. Okay, so what is remaining is simply to find the answer. So existing is given and they are asking by how much it should change. Okay, by how much it should change. So let us see the answers. Okay, so we'll read the question, every question we'll read clearly and we will solve. Okay, so they are asking us what should be the inflows. So we can simply say let the cash inflows be X. Yes. So obviously I am solving step by step. In the examination you can quickly just scribble the answers, quickly the working note, and you will get the answer. So cash inflows are X. And we know that what is the formula of NPV? The present value of inflows minus the present value of outflows. So outflows here is the investment and this should be your NPV. So present value of inflows is X and they have already given the present value factor, that is 3.546x minus outflow. Outflow is 10 lakh and project becomes indifferent. So NPV is 0. So simply solving the equation. So 3.546x is equal to 10 lakh. Is equal to 10 lakh. Okay, so solving the equation, so 10 lakh divided by 3.546. Okay, so the value of x comes to 2,82,008 rounded off. So if your inflows are 2,82,000, then your NPV becomes 0, and they have given the existing inflows. So what are the existing inflows? It is 3,40,000. This is given. So right now it is 340, and therefore we have to simply take the difference, that what should be the change. See, question is they are asking is what should be the change. They are not asking what should be the inflow. They are asking as compared to existing 340, how much it should change so that NPV becomes 0. So simply take the difference between the two. So the difference between the two is 57,992. So now let us see the options. 57,992. So we have the winner here, option 1. Remember, I am solving slowly so that you understand. In the examination, once you understand, you will get it in just a minute or maximum 2 minutes. So most important is understand the question. A question well understood is half solved. The only thing remains, put your pen on paper, put your calculator to work, and then you get the answers. Okay, so the most important point is understanding the question. Okay, so we are done with question 1. Now question number 2. So investor is planning to construct a minimum risk portfolio by investing in the shares of NAB and SAN. So there are 2 shares in a portfolio. So the moment we read, our mind should start thinking that it's a portfolio having just 2 shares. The risk associated with NAB and SAN are 23%. So risk associated, that means they are talking of standard deviations. If the covariance between the shares is 0, our life is simple, covariance is 0. What should be the proportion? That means they are asking the weightage. What should be the proportion? That means what should be the weightage of shares in NAB? So because there are just 2, so obviously one is 40%, other is 60%, one is 70%, other is 30%. So they are asking us what should be the ratio, what should be the weightage of money invested in shares of NAB. Okay, so the moment we have this, so there is a direct formula now. So let us see. So what is the formula? So the weightage of NAB. So N. I'll just write N. Normally we write weightage of 1, weightage of 2. Okay. So here instead of that we are writing weightage of N, weightage of S. So formula, weightage of N is equal to standard deviation of S square minus covariance of both, so N and S, divided by standard deviation of N square plus standard deviation of S square minus 2 into covariance of N and S. So now we put the data into the formula. So S standard deviation is given 25%, so square minus covariance is 0 upon N, it is 23%, that is 23 square plus 25 square minus 2 into covariance is 0, so minus 0. So solving the equation, 25 square is 625 upon 23 square is 529 plus 625. Okay, so when we solve the equation, we get the answer 0.5416. So if we convert them into percentage, simply multiply by 100. So we get 54.16%. This is the weightage of security N. Now let us see whether this is in one of our options. Yes, so option B, 54.16%. That is our answer. Okay, so once we read the question, see, remember that out of all the MCQs, few will be easy. And in some cases, you have to remember such complex formulae. It's okay. Okay, so see, it's an institute, it's a professional institute, so they will ask some complicated questions. We should be ready for it. Okay. Okay, the moment they ask something difficult, maybe they'll follow up by something easy. So it happens. So not everything is going to be difficult, but remember, not all the questions are going to be easy. So they also have to maintain a ratio between easy questions, average questions, and the tough ones. But always remember, the tough ones are less, the easier are more, then followed by average, and the least number of questions are the tough ones. So be positive and go ahead with this positive mindset. Okay. Now question number 3. The closing prices of the stock of Torrent Limited on consecutive days are given. Okay, so 5 days closing prices are given and they are asking us find out the relative strength. Okay, they are asking us to find out the relative strength. So the moment we see the word relative strength, so we remember RSI, relative strength index, and the formula of RSI, relative strength index, or relative strength, is the average. Okay, again we understand the concept. So what is the formula? The average of, okay, the average of ups. Ups means where the prices go up, upon the average of downs, that is the price going down. So how many days the price went up, you take the average. How many days the price went down, you take the average. That is the basic thought process. So average of ups divided by average of downs. Now let us see the data. So day 1 is the base. So on day 1 the price is 125. Okay. Day 2 the price is 135. So price has gone up. So I'll write down day 2 the price has gone up. Day 3 from 135 the price is 132. So day 3 the price has gone down. From 132 it has gone up, so 142 up. From 142 it has gone up to 145. Again it is up. So on 3 days the price is up. On 1 day the price is down. Okay. So the average of ups. So what is the average of ups? So average of up is first is 135.25 plus 142.75 plus 145.25 and average. So it is 3 days. So the average will be upon 3 divided by the average of down. Down is just 1 day. So we just write down one figure, that is 132.75. Okay. See, there are few more methods of calculating. So one of the method of calculating RSI is you take the difference. Okay, so what we do is we take the difference between 125 and 135. So it comes to say 9.8. Then we take the difference between them. It comes to 2.5. So that is another method of calculating the RSI. Okay, here we are going with the most simplest of methods. So instead of taking the difference, we are taking the number of days on which it is up, number of days it is down, average. Okay. So then we solve this equation. So 135, let us see, 135.25 plus 142.75 plus 145.25. So the numerator divided by 3, it is 141. Okay, the numerator comes as 141.08 divided by 132.75 divided by 132.75. The answer comes to 1.0628. So do we have a 1.0628? Yes, we have. So answer is option C. 1.0628. Okay, so this is a simpler method. I will say I use the word, it is a crude method. Okay, professionally the method is taking the difference between the two prices, but this is a crude method, and the institute answers what options the institute has given, they are based on the crude method, not the practically used method. In fact, the same question was asked again later on in 2024 or 25. I just don't remember the exact year, but yes, the same question with the same data was asked again later on. Okay, so this is the answer to question number 3. Then question number 4. Let us come to question number 4. A project has an NPV, base case. So the moment we read the word base case, correct, our mind is immediately, they are talking of adjusted NPV, ANPV, adjusted. So what is the meaning of adjusted NPV? It is basically the NPV of pure equity, that is base, plus the tax saved on debt. So that is the concept of adjusted NPV. It is a combination of pure equity, no leverage, no debt, that is base, plus you adjust the tax saved, because if there is borrowing, there is interest cost. On interest cost, there is tax saving. So that tax benefit on the debt, you add it to that. That is the formula. So what they are asking us, that the base NPV is given 1,20,000. However, this project has one financial side effect. The firm's borrowing power 4,80,000, and the project lasts indefinitely. It is treated perpetual debt. The borrowing rate is 15%, and tax shield, that is tax rate, is given, that is 35%. So what will be the ANPV, that is adjusted? Okay, let us solve here itself. So the formula is base. Okay, base NPV plus debt tax shield. That is the formula of adjusted NPV. Now the base is already given. So base is already given, that is 1,20,000 plus, so debt. Okay, what is the debt amount? Debt amount is 4,80,000. 4,80,000 into interest rate, that is 15%, into tax rate, that is 35%, upon, since we are going to do that, upon the rate interest again. So in a way, shortcut method, you can directly do debt amount into tax rate, because this 15 will be cut, 15 will be cancelled, and therefore the base is 1,20,000 and 4,80,000 into 35%, so it comes to 168 plus 168. So 168 plus 1,20,000. So the adjusted NPV, our answer comes to 288. Adjusted NPV comes to 288. So do we have an option of 288? The answer is yes, option B. So the answer is option B. So adjusted NPV, modified NPV, okay, frequently asked questions. So make sure you do them nicely, especially for the coming June exam. Okay, so question 4 is done. So concept, calculation, answer. Okay, let us go ahead. The current price of ACC stock is rupees 1010. Okay, that is the current price. So current price, we may also use the word as spot. What is the spot price? Is 1010. It is expected that the price of stock may either go up to, so up to 1212, or down. So the moment we are reading the question, that they have given today's price and they have given two options, one upper, one lower. So the moment we read the question, we immediately clicks that they are asking based on binomial model. Binomial, two options, either one is up, high, one is low. So their question is on binomial model. If the stock price of call option of ACC, okay, stock option of call. So this is the strike price given. So in this question, strike price and spot price are same. They may be different in some other question. And the risk-free rate, RF. The risk-free rate is given, that is 6.5%. What is the probability of decrease in the stock price? Probability. So there is a direct formula. So one is binomial model, again frequently asked probability question. Okay, and let us solve using an easy formula. Okay, so all the information we have identified. So the formula is probability of high price. What they are asking? Probability of decrease. So there are only two options. So what we do is we find the probability of high price. So if high price answer comes 70, then low price will be 30. If high price answer is 55, then low price will be 45. So that's what we have to find out. Okay. So formula, what is the probability of increase? First we'll find out probability of increase. They are asking decrease, which is a complement of increase. So we'll come to that. So the formula is spot, okay, into 1 plus RF. In some cases, we also use the formula e raised to the power r. Okay, sometimes the information is telling you that okay, use the Euler's model, that is e raised to the power r. So that is one way of doing it. And in this case, we are going with the simpler method, that is 1 plus RF minus. Okay, there are two options. One is the high level, one is the low level. So we are looking at the minus the low price or low level upon the high level, that is high price, minus the low level, that is low price. Simple formula. So spot into 1 plus RF. Okay, so RF either directly or using continuous compounding, that is e raised to the power 1.065 minus low price. So let us put the data. So what is the spot price? Spot price is 1010 multiplied by 1.065, that is 1.1. Okay, I'll simplify it further. I'll not miss this check. Okay, so 1 plus 6.5%, that is RF, minus low price. So low price is 808 upon what is high price? 1212 minus low price 808. Okay, so let us solve the equation. So 1010. So 1 point, that is 6.5% that we know. So it comes to 1.065 multiplied by 1010. Okay, minus 808. Minus 808. That is your numerator. Okay, upon denominator is 1212. Okay, right here. So numerator comes to 267.65 upon what is the denominator? 1212 minus 808. So denominator is 404. Denominator 404, and therefore 267.65 divided by 404. So answer comes to 0.6625, and this is the probability of increase. Simple. So if probability of increase is 0.6625, so 1 minus probability of increase. So final answer, hence probability of decrease, this is what they are asking us, it is 1 minus 0.6625. Okay, and that comes to 0.3375. And do we have a 3375? The answer is yes. So we got the answer 0.3375. Please don't forget the last step, because what students do is they get the answer of 6625 and they match it with option 1, and they are in such a hurry that okay, done option 1, option A. But remember, 6625 was probability of increase. What we wanted is probability of decrease. So 1 minus probability of increase will give you probability of decrease. So answer is, final answer, 0.3375. So high chances again of binomial model coming in the June exam as well. So please remember the formula, easy formula. Okay, so spot price into the 1 plus RF. If the data is clear that we have to use e raised to, use then that formula. In another question, we'll use the continuous compounding also. Okay, minus the low level or the low price divided by high price, high level, minus low price, low level. So solve, put the data, get the answer, it becomes easy. So just have to remember the formula. Okay, let us go ahead. Okay, now this question, options theoretical value increases. So options value increases if the interest rate decreases. So now this question is based on, okay, this question is based on option Greeks, as we call them, option Greeks. So we have delta, we have gamma, we have theta, we have vega, and we have rho. And every option Greek has its own relationships with the premium. Okay, means for example, if you consider theta, then it is the measurement of time value as time passes. What is the effect on option price, that is premium. If you talk of vega, it is talking of the volatility and its effect on option premium. And when you talk of interest rate, then it is measured by rho. Okay, so the change or the effect of interest rate on the call option or the option price, I will say. Let us keep it general. So the effect of interest rate on option price is measured by rho. Okay, so one thing is sure, that gamma won't be an answer. Theta is for time value, so theta won't be an answer. So answer will be rho. So first things first, that option A and B are gone. Pure concept. Now the confusion, now there are two row answers. So C also says row of put option, D says row of call option. Okay, now let us see the question. Option value increases, this is going up, and the interest rate is decreasing, this is going down. So they are going in opposite directions. It's a simple trick. Okay, they are going in opposite directions. Okay, that means we are talking of put option. So the correct answer is put option, because put option is right to sell, we are bearish. Call option is right to buy, we are bullish. As a call buyer, we are bullish. So if the question was that option value rises and interest rate also rises, if that was the question, then our answer would have been row of call option. But because the question is that value is increasing when interest rate is falling in opposite directions, then it's a simple trick, easy to remember. For MCQ purpose, obviously, that answer is C, interest rate of put option. So that is called as pure theoretical concept based. There is no calculation involved. Just read the question, remember the Greek relationship, and last step, if both are rising together, call option. One is rising, one is falling, put option. So this question is also done. The next question is based on Forex. So an export customer, every word important, export customer who is relied on interbank rate of rupee to dollar, and the rate is given 80.50, is requested his banker to purchase the bill. So now see, he is an exporter, so he has received dollars. Okay, he has dollars from his foreign customer. So he will go to the bank and tell the bank, sir, please take this dollar. Bank says, okay, we will buy dollar. Okay, so bank is buying the dollar, so we have to use the bid rate. That is the concept. Okay, so exporter will always get the bid rate as far as the direct quote is concerned. And here the data says it is a direct quote. So if the banker wants a margin, so banker also, obviously, for a bank, currency is a business. And a normal businessman, what they will do, they will buy at a lower price. Simple business rule, you purchase at a lower price, you sell at a higher price. And what is the margin they have asked? That the bank will maintain a margin, keep a margin of 0.10%. Okay, so the rate is given, $1 is equal to rupees 80.50. The rate is given, and because the bank is buying the currency and the buyer will always prefer to buy at a lower price, and therefore we subtract the margin. If it was an importer, okay, I'll tell the other side also. If the question said importer, so the bank would be selling them. So it was importer, then we would have added the margin. Because it is exporter, bank is buying, we always buy at a lower price, and therefore margin will be subtracted. So what is the margin? 0.10%. So on the simple calculator, 80.50 minus 0.10%. So the answer comes to, they have said round off to 2 decimal. The answer comes to 80.419. So 419 round off to 42. 80.42. So do we have an 80.42? Yes, we have. So answer is option B. Okay, so concept exporter, he will get the buying rate from the bank under direct, and bank is buying, so obviously they will prefer to buy at a lower rate. So in case of exporter, direct quote, bank, margin, subtract. So therefore we subtracted the margin and got the answer. Okay, next question. Consider a bullish spread option. Now this question is based on option strategies. And what is the strategy they are taking? They are taking a bull spread strategy using a call option. So if you're good in derivatives and if you remember the strategies, then this question will be easy to you. But if, for example, if you are not so confident and you have left the strategies for option, then the question on option will be an option. So instead of wasting time, you may go to the next question. But we will see how to solve this. So it's a bull spread strategy using call option. So bull spread using call option on a stock with a 60 rupees exercise price and a premium of 6, and 75 exercise price, a premium of 3.5. The current price of the stock is rupees 67. This is the current price, that is spot price. And if the price of stock is rupees 95 at maturity, so maturity is after 1 month, 2 months, whatever. We also use the word expiry. Another word for maturity is expiry. The actual price is 95. What will be the net profit or loss, whatever it is? Okay. Chalo. So now let us first understand the concept. Okay, let us understand the concept. So concept is that they have taken a bull spread. The strategy used is bull spread strategy and on a call option. So what is the strategy in bull spread? The strategy is you buy a call option. Okay, you buy a call option at in the money, ITM. You buy a call option at in the money. That means your exercise price is less than the current market price, that is in the money. At the same time, you sell another call option. That means, other word is, you write a call option, but this will be out of the money. So I'll repeat again concept. What is in the money? So in the money means the strike price is less than today's spot price. That is in the money. And obviously opposite is out of the money. So out of the money is today's strike price is higher than the spot price. That is the concept. So in a bull spread strategy for call option, the person will buy. So he is a call holder for this, and he will sell. That means he is a call writer for the second option. Okay. So now let us see what happened. Okay, spot price is given. So what is the spot price? Spot price, let us see the question. Yes, so spot price is given as 67. And so let us first identify what are the, now this is 61 option, second is 75. Okay, 60 and 75. So if today's price, okay, we are also learning another concept here, ITM and OTM. If today's price is 67, okay, so buying a call option, strike price is less, so he will choose a strike price here. The strike price here, whichever, there are two strike prices given, so the lower one will be here, that is 60, and the another strike price is for the other option, that is also given, the higher one will be taken here. See, strike price higher than spot. This is the concept of ITM. So in ITM, what happens, that your strike price is less than today's spot price for a call option, and OTM is out of the money, ITM is in the money. Okay, so this is what is the strategy. Now what happened is, at expiry, at maturity, okay, the market price became 95. Okay, at expiry, the market price became 95. Okay, so now what he is going to do? Let us see what he will do. So here he has a option, because he is a call holder, he has a choice. So what was his choice? He had a choice of buying the stock at 60. That is the meaning of call buyer, a call holder. He had a choice of buying the stock at 60 and market price is 95. So whether he will buy and exercise at 60 or he will let the option lapse and go at 95, common sense, 60 is cheaper to buy, and therefore he will exercise his option. And the moment you exercise the option, there is gain. Okay, there is gain. So gain is the difference between them. So gain is 35 rupees. But we also know that he has to pay a premium. He is an option buyer. He has to pay a premium. So let us see, for a strike price of 60, what is the premium? So for a strike price of 60, the premium is 6 rupees. Okay, the premium is 6 rupees. So this he has to pay. He has to pay. And therefore, what is his net payoff? What is his net on this first option? 35 minus 6, that is rupees 29 positive profit on this. Now let us see the next one. Now here he has written an option. He has sold an option. That means he doesn't have a choice. The other person will have a choice. That means the other person will have a right to buy at 75 and market price is 95. The other person will exercise and our investor will have a loss of 20, because the other person will exercise and the difference will be a loss of 20. But because we have sold the option, we receive premium. Correct? The concept is simple. When we buy an option, we pay premium. When we sell an option, that is option writer, we receive the premium. So in this case, the premium we have received is 3.5 plus. And therefore, what is the net effect? Minus 20, okay, minus 20 plus 3.5. So the net effect is 16.5, but loss. So I'll write in bracket. So 16.5 is a loss on option writing, and 29 is a gain on option buying. So finally we want the net amount. Okay, so this is the profit, this is the loss. So finally difference between them is your net. So 29 and 16.5, so difference is positive 12.50. So net of net, okay, net of net, so end result is he earned 12.50. So let us check whether 12.50 is one of the options. The answer is yes. Alternative C, option C is 12.5. Okay. So you solve this question only if you are confident about your option strategies. Otherwise, it takes time. See, I have solved very slowly. Okay, but if you know the strategy well, you know exactly what is going to happen, then you can solve it in 2-3 minutes. So first I explained you what is in the money. That means at the time itself, at the time of starting the contract, you are already in the positive. And that's why in the money will always have a higher premium, 6 rupees. Out of the money, that means at the time of starting the contract, you are in a adverse position. And therefore the premium was also less, 3.5. Okay, that is again concept. Premium is connected to whether you are in the money or out of the money. Okay, so this is the answer of question bull call spread. Okay, next question is on Sharpe ratio. Okay, Sharpe ratio, trainer ratio, the risk premium of the fund. So risk premium means RP, that is return of portfolio minus RF. That difference is already given 6. Standard deviation of the fund. Okay, standard deviation of the fund is already given 11.8. Standard deviation of market sigma M is given 9.56. The correlation coefficient they are asking, what is R? Correlation coefficient between them. So now correlation coefficient, this is used only in the case of beta formula. Okay, in the case of beta formula, and the beta formula is used in trainer ratio. Check. Let us solve both. Let us understand. First, I'll write down the formula here. Let us write down. Yes. So Sharpe ratio. Sharpe ratio is return of portfolio minus RF upon standard deviation of portfolio. And trainer ratio is RP minus RF. So the numerator is common upon beta. Again, concept wise, Sharpe ratio is about the overall risk. It will tell you systematic as well as in unsystematic risk, but trainer ratio is talking only of systematic risk. The conceptual difference between both the ratios. Now Sharpe ratio is given to us, that is 0.37. RP minus RF, this is directly given to us as 6. And using this, we can get standard deviation of portfolio. So standard deviation is 6 divided by 0.37. So we get the answer, standard deviation of portfolio, that is 16.22. So we got this first answer. Then trainer ratio is also given. So trainer ratio is given 4.16. This is also given, that is 6. And we have to find beta. So by this calculation, we get the beta value. So beta value is 1.44. Simple. Just put the formula, substitute the values. So we got standard deviation of portfolio. We also got beta. And now we know, once you have these two information, so we know that beta is equal to standard deviation of portfolio upon standard deviation of market into R. This is the formula of beta, out of which R is the missing figure. Rest all the information we have. Okay, so substituting, so what will be R? Okay, let us substitute the values. So beta is 1.44 is equal to 16.22, okay, upon our standard deviation, this is given market 9.56 into R. So R is the missing figure. So calculating R, so what we do, 1.44 multiplied by 9.56 divided by 16.22. So value of R comes to 0.85. Okay, value of R is 0.85. Let us see whether 0.85 do we have in one of the options. Okay, answer is yes. So option B is the right answer, 0.85. That is question number 9. See, this paper we are solving is of December 2022. And in those years, the institute's pattern was slightly different. They used to ask only 10 MCQs and the remaining was the numerical part. And later on, they increased the MCQs to 50. Okay, so earlier 1 or 2, 3 papers, there will be 10 MCQs, and then later on they increase the number to 15. Okay. So the 10th MCQ, the last one of this question paper. A call option is written for a strike price of 400. Okay, call option is written, okay, call writer for a strike price of 400 with a premium of 50 rupees. So what is the meaning of this? The meaning of this I'll write down. It's a option contract. We know that in an option contract there are two parties. One is known as the option holder, other is known as the option writer. Option holder pays the premium, option writer receives the premium. Again, concept I am discussing. For an option holder, his maximum loss is premium, and for an option writer, his maximum gain is premium. That is the concept of option holder, option writer, and what is their maximum profit or maximum loss. So in this question, the premium amount is 50 rupees. That means the option holder, okay, option holder, his maximum loss is 50, and option writer, his maximum gain, that is profit, will be 50 for both the parties. Now let us use this concept and check the answers. So what the answers they are saying? Okay, what the answer they are saying? The holder's maximum loss is 50, which is correct here. Holders, this is the holder, maximum loss is 50. So answer A looks good. Holder's maximum gain is 50. No. So obviously this is the wrong answer. Writer's maximum loss is 50. This is again the wrong answer. And writer's maximum gain is 50. Yes. Yes. So now what happened is here, if you observe, okay, option A also looks good. Concept wise, yes. And option D also looks correct concept wise. So concept wise, A is also right and D is also right. Okay. Now this creates a confusion. But now to solve the confusion, it may happen. See, that's why we are solving the actual paper. So you know that such confusion may happen. So how to go about it? Read the question. A call option is written, and therefore they want the answer from the writer point of view. They don't want the answer from the holder point of view. They want the answer from the writer point of view, and therefore writer, the correct answer is option D. So even though A was valid, D was also valid. But the question was asking from call option written, and therefore D is the best answer. Okay, D is the best answer. Okay, so this is the MCQs of December 2022. So different concept we touched. Okay, option strategies, option Greeks, foreign currency, adjusted NPV, and so on. Okay, so now let us go ahead to the next paper and next MCQs. Yes. So now we go on to the next paper. So after December 22, okay, so we are going towards June 23. Now June 23, there will be two papers. One is the old pattern and the new pattern. So we'll solve both. See, finally the MCQs are concept. So whether it is an old pattern or a new pattern, the subject is same, the concepts are same. So the more we solve, the more we practice and the more confidence we get. Okay. Okay, so let us go ahead. So June 23 and old pattern. First question. So old pattern, as I said, 10 MCQs used to be asked, and as they shifted to new pattern, earlier again they repeated 10, but thereafter they increased to 15 MCQs. Okay, so first question is, a project of Axon Limited requires 30 lakh investment. So outflow is 30 lakh and expects perpetual cash inflows. So cash inflows are perpetually, that is 8 lakh. Okay. Then what else is asked? The business risk ventures 20% discount rate. As the project is considered desirable, it acquires for a government grant of 10 lakh. So now the question is involving government grant, and again the question is asking what will be the adjusted NPV. Now normally in adjusted NPV we use the concept of debt, and in debt we have the tax rate, the tax shield, base rate plus this. That's what we do. But in case of government grant, it is actually easier. Okay, so let us see the formula and let us solve. Okay, so first we have to find base. So even they have not given the base NPV, so we have to find the base NPV and the answer. Okay, yes, so adjusted NPV is equal to base NPV plus, here the answer is even easier, plus government grant amount. That's it. That's it. As simple as that. So now what is the base NPV? So for base NPV we require the inflows, and since they are perpetual we use the annuity formula. So inflows upon the discounting rate. So this will give you present value of inflows minus investment. So this will give you NPV plus the government grant. Okay. So annual inflows they have given, it is 8 lakh. The rate minimum expected ROI is given 20%, and the investment of the project. Okay, what was the investment? 30 lakh. The outflow, that is investment, is 30 lakh. And there is a government grant. So we add government grant. So government is giving you 10 lakh. So straight away 10 lakh. Okay, so calculation. So 8 lakh divided by 20%. So that gives us 40 lakh. So 40 minus 30. So base NPV is 10 lakh plus government grant is 10 lakh. So the final answer is adjusted NPV should be rupees 20 lakh. Okay, so 20 lakh. Do we have 20 lakh? The answer is yes, option B. Okay, so option B is the answer to question number 1. Question number 2. Now this is a theory based question. So purely concept, no calculation. Know the concept, take the answer. It takes less than a minute. See, that's the best part of theory questions, that if your concepts are clear, time required is 1 minute. And now see the funny side, if your concept is clear, you get the right answer in say 10 seconds. And if you absolutely have no idea of the question, absolutely zero idea, then you will leave the question in 10 seconds. So that is then just your luck, because you don't know. So there's nothing to think. You just have to guess. Okay, just have to guess. You tick any answer and then you go ahead, save time. Okay. So an instrument of debt having investment grade. The moment the word grade comes, correct? So immediately you are thinking of credit rating. So rating by agency. So we have to choose the right answer. Implies that investment is safe. So whenever any CRA, that is credit rating agency, so what they give an opinion about the debt instrument. Remember, it's always an opinion. It's never a suggestion. It's always an opinion. Please remember this. Now based on this concept, let us read the options. Okay. So first option says implies that the investment is safe. See the wording, implies that investment is safe. Credit rating agency never says that this is safe and this is not. It's just an opinion, and recommends. They never recommend. They never recommend. Okay. So again, this is purely concept. Credit rating agency never recommends, and therefore option A will not be there. Option 2 implies that statutory compliances. They don't talk of legality. They talk of credit worthiness. So statutory is not a concern, and therefore option B is gone. Option C implies that the investment is sound at the time of issue and the issue price is reasonable. So reasonable is they are talking of valuations. They are talking of valuations. They never talk of valuations. They never say that investment is sound. That means they are telling they are strong. Agency never says this. And the first word I use, it's always an opinion, implies an opinion of the agency that the instrument will pay back the capital, that is repayment, and they will pay the interest. That is my opinion, and therefore the answer is D. So here what concept we used is, this is called as selection by elimination. Okay, this is called as selection by elimination. So we eliminated A because they never recommend, so A nahi ho sakta. Then we removed B because they never talk of statutory, so B also is not possible. We removed C because they are saying that investment is sound and tough and everything. Valuation they're talking, again that may not happen, that is not possible, and therefore first A, B, C are not correct, and therefore D is correct. So this is called as theory of elimination. So you reject the three, so automatically one is the right answer. Okay, that is second question. Let us go to the third question. Okay, let us go to the third question. A trader is having a portfolio of shares of 85 lakh at current market price, at current valuation that is, and also some cash of 15 lakh. The beta of the share portfolio is 1.6. So beta is the degree of systematic risk. After 3 months, the share price dropped by 3.2%. If the trader on a current date goes for a long position, so here we are talking of hedging. So what the trader is done, that he has taken a long position on 100 lakh Nifty futures contract. What is the value of market index after 3 months? What is the value of market index? Okay, so slightly the question is revolving around the concept of hedging that we understood. There is a portfolio, he has hedged it using futures. Okay, then normally for hedge ratio they give beta, so beta is given here. Okay, that is also there. Then 85 lakh beta, because the cash here, so cash is in hand. So what is beta of cash? 0. Okay, beta of equity is given and beta of cash is 0. That is also given. Then Nifty is given. Okay. Chalo, let us see. So what is the formula of beta? Let us understand from beta. So beta is the relationship between our portfolio and the market portfolio. Okay, beta is the relationship, that is change in my portfolio, and around change in my portfolio upon change in market portfolio. That is the meaning of beta, relationship. Relationship between the market, that is Nifty for example, in this case futures, and my portfolio, whichever I have. So now beta value is given, so beta is 1.60. Okay, and after 3 months the price of share dropped by 3.2. My shares, so shares is my portfolio, so my portfolio dropped by 3.2. There is a fall, change. So what will be the market change? So using this formula we have to find what happened to the market. Now beta is 1.6, so beta is positive. So positive beta means my portfolio and market will be in the same direction. That is an indirect and implied meaning of a positive beta. It may be 0.5, 1, 2, 3. As long as beta is positive, it means my portfolio and market are in the same ratio. Both will go up, both will come down. They are in the same direction. So if my portfolio has gone down by 3.2, so what will be change in the market? So change in the market will be 3.2 upon 1.6. So the market will come down by 2%. Market will come down by 2%. So 3.2 upon 1.6. And what is the value of market? Market value is 100 lakh. So the futures contract originally was 100 lakh. And this 100 lakh will fall by 2%. So what is the value of market? 100 minus 2. So the value of market should be 98 lakh. So do we have 98 lakh? The answer is yes. So correct answer is option C, 98 lakh. So concept of beta, it is a relation between change in my portfolio upon change in market. So information given, from that we found out what is the change in market. So market fell by 2%. Originally Nifty futures was 100 lakh, falling by 2%, it will become 98 lakh. So that is the answer of question number 3. Now coming to question number 4, mutual funds. So mutual fund has a NAV of 8.6 at the start of the year. 8.6, and the fund distributed dividend as well as capital gain. These are the benefits during the year. If the fund's return, that is the ROI, at the end of the year is 26.16, that is what the investor earned, return on his investment, what will be the NAV at the end of the year? Find the end NAV. Okay, so simple. So mutual fund, it is called as holding period returns. It's a very simple concept, holding period returns. You hold the fund for 1 year and holding period returns. Formula is very simple. Okay, NAV at the end minus NAV at the start plus any dividend you received or plus any capital gains you received upon NAV at the start, because you bought the funds at the starting NAV. So denominator will be your investment, which is this. That's it. So just this is what is the missing figure, NAV1. So we assume that as X, end of the year, minus NAV at the start of the year, which is given 8.60, plus dividends they have given 0.80, plus capital gain they earned 0.70 upon 8.60, and earning this they have given the ROI holding. This answer is given. Normally what happens is, normally they say find out return percentage. They will give all the other information and they will ask us to find out the returns. Here they have given the returns and they want you to find out the missing figure, that is NAV at the end of the year. Okay, so now simple, 8.6 will go on the other side. So 8.6, different ways. This is, as I said, is simply solving an equation using different ways. So once this will go here into this, so this comes to 2.24 or 25 approximately, and here it is x minus 8.6 plus 1.5. So if you solve the equation, the value of x comes to rupees 9.35. NAV at the end of the year, value of x 9.35. So do we have 9.35? Yes. So question 4, the answer is B, 9.35. Simple formula, holding period returns. And another way you can also call it is realized yield. Okay, original, that is selling price minus buying price. So what is selling price? End of the year, NAV 1, minus buying price start of the year, NAV 0, plus during the year dividend and capital gain upon starting price, NAV 0. Easy. Okay, now next question, Sharpe ratio and trainer ratio. Okay, Sharpe ratio is given and 0.56, trainer ratio is given 9.8. Correlation between the returns of the fund and the market, that is R, is 0.7. What is the standard deviation of market index return? So standard deviation of market. So this is what is asked, standard deviation of market. Okay, so they have given very less information and they want us to find standard deviation of market. Okay, let us see what we can do. first let us put the formulae. So Sharpe ratio is our returns of portfolio, returns risk free upon standard deviation of portfolio. Then trainer numerator, same returns of portfolio minus returns of risk free upon beta. Concept wise, Sharpe ratio overall market risk, trainer ratio only systematic market risk. Yes, so Sharpe ratio is given, that is 0.56 is equal to, both are not given, and this is also not given. Okay, so we are stuck. So what we can say is, okay, we can say that 0.56 into this is equal to RP minus RF. This much we have reached. Rest all missing figures. Then trainer ratio is also given. Trainer ratio is 9.8 is equal to RP minus RF upon beta. And whether beta value is given, I guess yes. So beta value is not given. Okay, beta value is not given. Okay. Upon beta. Again we have 9.80 beta is equal to Rp minus Rf. So in this equation Rp minus Rf, this equation Rp minus Rf, they are common. So if RHS is same, correct, school days, RHS same, so LHS will also be same. So LHS will match. So if LHS matches, so I can write 0.56 standard deviation of portfolio is equal to 9.80 beta. RHS matches, LHS matches. ठीक है. ठीक. Then if I have this equation, okay, if I have this equation, then what will be value of beta? Okay, value of beta will be 0.56 divided by 9.8. So beta value will be 0.56 upon 9.8 into standard deviation of portfolio. So doing this, we get the answer 0.0571 standard deviation of portfolio. So we are going a long route. The simple reason, data is very less, very less information available, and therefore we have to go different, slightly longer route. Then what is the formula of beta? So beta is standard deviation of portfolio upon standard deviation of market into R. This is the formula of beta. So now we have to substitute the values. So beta, okay. So see, beta is this. So I'll write here 0.0571 standard deviation of portfolio is equal to standard deviation of portfolio upon standard deviation of market into R, and R they have given. R is 0.70. So what will happen? These two will cancel each other. Okay, these two will cancel, divide on both sides, that will be cancelled, and therefore solving the equation we get standard deviation of market. Okay, standard deviation of market will be 0.7 divided by, okay, 0.7 divided by 0.0571. So 12.25. Answer comes to 12.25. Let us see whether we have, after so much long calculation, whether we have 12.25 as an answer. Answer is yes. So we have an answer 12.25. Okay. So because the data was very less, therefore we had to go this long. In the examination, you have to judge when you see the question and you realize that okay, very less information. So what you do is, okay, my suggestion is skip the question right now, go to the next one, because for 2 marks you can't spend 20 minutes, and maybe you will be stuck in the over calculation, and then you will be frustrated, and then the patience and the stress rises. So when you feel that okay, this is out of my coverage area, then it's better to leave it right now, and if time permits at the end, you come back to the question. Okay, that strategy, that presence of mind you have to have. Okay, next question. The current market price of an equity share is rupees 400. Okay, current market price is given rupees 400. And it is expected that the stock price after 3 months will be either 432 or 360. The moment you see two possibilities, we know that this is based on binomial model. This question is based on binomial model because there are two possibilities. By is two possibilities. If the risk-free rate of return, that is RF, is 12%, what should be the value of 3-month call option? So they are asking us to find the value of 3-month call option under the risk neutral method, and the strike price is given, that is exercise price 388 rupees, and they have given the values. If they had not given the values, then we know how to calculate. Okay, using a normal calculator, you know the trick. Square root 12 times minus 1 and then multiply by the rate plus 1 again into 12 times. So you know the thing. Okay, so now we have to find out the value of call option under these two possibilities. Okay, what are the two possibilities? I'll just put the question here first. So today's price, okay, today's price is 400, and there are two possibilities. First possibility, the price may go high at 432 or the price may go low at 360. Now, just understanding the concept of call option holder is bullish. That means he will exercise the option if the price goes above. See here, this is 400 and strike rate. What is the strike price? 388. I'll write down here in between. The strike price is 388. So if the price goes to 432, he will exercise the option, because call option bullish, price up, exercise the option. If the price falls, he will let the option lapse, he will let it go. Okay, so if the price is 432, he will exercise the option and there will be gain. If the price goes down, then he will let the option lapse and gain will be 0. Premium, yes, premium comes later, but the gain, when the option lapses, the gain becomes 0. That is the conceptual part. Okay. Okay. So concept. See, every MCQ we are trying to understand the concepts. Okay, this was the earlier question. We'll go ahead. Okay, we'll go ahead. Yes. So what is the formula? As per binomial model, the value of your option, as per binomial, the value of your option is your expected payoff. Okay, your expected payoff upon 1 plus RF raised to the power n. If this is given, then we use this e to the power RT. In this question, e to the power RT is given, so we use that. Okay. So now before going here, we also have to find out the probabilities. Okay, we have to use the probabilities of high price, probabilities of low price, increase, decrease, that is. So now this is again for a MCQ kind of question, this is a pretty long calculation. So again my suggestion, if they are asking only probabilities, then we can do it quickly. Okay, but here probability and then value of option. Okay, so probability of increase. Probability of increase. What is the formula? Probability of increase, spot into 1 plus RF. Okay, 1 plus RF minus low price upon high price minus low price. Okay, high price minus low price. So what is the spot price? Okay, what is the spot price? Spot price is 400. Okay, spot price is 400, and here they have already given e raised to the power RT. This is given to us minus low price. Okay, what is the low price given? Low price is 360 upon what is the high price? High price is 432 minus 360. Now the RF is given 12%. Okay, the rate is given 12% per annum. Okay, but the option duration is 3 months. So if 12% is for 1 year, then for 3 months, obviously we have to take the value of 3. And therefore 400 multiplied by, okay, what is the value given for 3? Let us see here. Yes, so we have to take this value, 3%. So e raised to the power 3%. So 400 into 1 point, okay, sorry, it's the value 1.03045. 1.03045 minus 360 upon 432 minus this. So this is 72. Okay. So when we solve this equation, so 400 multiplied by 1.03045 minus 360 divided by 72. So the probability, okay, the probability of increase we get is 0.7247 approximately. This is the probability of increase. Now we go to the formula of, okay, now we go to the formula value of option. So value of option, see there are two possibilities. One is higher, one is lower. But one thing we know, if it goes higher, we will exercise. So there will be gain. If it goes lower, okay, we will let it lapse. So if probability of increase is this, okay, probability of increase is this, then what will be probability of lower price? That is probability of decrease. Okay, 1 minus this, so it will be 0.2753, just for our understanding. Okay, so value of option, we have seen the formula above. What is value of option? This is the formula. Value of option, expected payoff. So expectation, and that is why we have to use probabilities. So value of option, that if the price goes up, so up price is 432 minus strike price. This is the gain. And what is the probability of this happening? 0.7247. This is first. And second, if the price goes down, we will let the option lapse. And we will let the option lapse. Therefore, gain will be nothing, 0. 0. Why 0? Because the price is below. Call option, higher price, exercise, below the strike price, lapse. So lapse means gain is 0. Divided by, okay, divided by e raised to the power RT. okay, divided by e raised to the power rt. That is the formula. Okay. Okay, so let us see the calculations. So a slight technical issue in between. So 432 minus 388. So this is 44, that is the gain because you exercise the option, into what is the probability of this gain? 7247 plus 0 because the option is going to lapse, and divided by e raised to the power r, and here r will be 3%. So we use the same thing we use here, upon 1.03045. This is given in the question. So 44 into 0.7247 divided by 1.03045. Solving, we get the answer rupees 30.94. Value of option is 30.94. A lot of work for 2 marks. Okay, so let us see whether 30.94 is in our options, in our alternatives. Let us see here. So yes, option A, alternative A is 30.94. That is the right answer. So as I said, too much of work for 2 marks. So again, my suggestion would be, such a big question comes, keep it at the end. Do not waste so much time for 2 marks. Okay. Then, now next is a theory question. Either you know or you don't know. So while plotting a graph with a risk on x-axis and returns on y-axis, a line drawn with coordinates ORF, beta, R, M. So the moment you see the word beta, then systematic risk is CAPM. CAPM is security market line. And therefore, the straightaway answer, if you know the concept, then you know the answer. The answer is SML, security market line, where that slanting one, okay, the transverse one is the RF minus RM, then one is the x-axis, y-axis. So answer is straightforward. As I said, either you know or you don't. So here we know answer is security market line, option A. Then next question is, the project of Zent Limited has a mean NPV. Mean is average. So average NPV of 600. The project manager determined the probability of the project using different ranges. So the moment we read the word ranges, okay, the moment we read the word as ranges, we immediately know they are talking of normal distribution curve. If the standard deviation of NPV is 300, what is the probability of NPV between the range of 375 and 675? Normal distribution, like inverted bell curve. That is what, and they are given the range of Z. Okay. Let us solve. So we know the formula Z1, Z2. There are two ranges, and NPV is given. Standard deviation is given to us. So what is the formula? Okay, what is the formula? So Z1. Okay, two ranges. So Z1, normal distribution curve. So formula is, first I'll give the basic formula. So the range minus mean, average, upon standard deviation. Okay, for Z1, the range is given as 375 minus average is 600 upon mean. So 300, so answer comes as minus 0.75. If you do the calculation, 375 minus 600 divided by 300 minus 0.75. Then Z2 second value is 675 minus 600 upon 300. So this comes to plus 0.25. This is positive, one is negative. So basically they are ranges on this side, on the other side. And now the given data, what the given data says, let us see. Okay, so we got two answers. So one is 0.25 and one is 0.75. The positive negative doesn't matter because it's on two sides. Okay, so this is a range. So what is the answer of 0.25? The answer is first range is area under the curve. We call it area under the curve. Okay, Z1 and Z2. So 0.75, it is 0.27337. So we take this value, and Z2 0.09871. So we have to do a simple addition. So what is the question? What is the probability of the range? So simple addition, 0.27, okay, 27337 plus, okay, so if you add them, 0.37208. So if you multiply by 100 percentage, 37.21%, and therefore answer is B, 37.21%. So for this standard deviation or for this normal distribution curve, the only thing you must know is the formula. So if you are aware of the formula and then just put the values, find it in the table given, add them, and your answer is ready. So if you know it, it's a matter of 1 to 2 minutes. That was question number 8. Now question number 9. The following currency codes are given and they want the rate at which, okay, they want the rate at which 100 yen can be purchased with rupees. Okay, so if you read the question, they are saying 100 yen can be purchased. So we are buying, that means bank is selling. So if bank is selling, then we have to use the ask rate. Okay, so you are given these rates. Okay, you are given these rates. So from these rates, we have to pick up the ask rates, the selling rates of the bank. Why? Because 100 yen can be purchased. So we are the buyer. So bank is the seller. And we have to use all the ask rates. So first we'll plot the rates, and then using the concept of cross rates, we will find the rate of, see, they have given rupee to pound. The first thing they have given is rupee to pound. Then they have given is pound and dollar. Then they have given is dollar and yen. So different combinations. And what they want yen and rupees, which are not directly. So through cross rate, we have to achieve this target. So let's first write down the rates and then we'll solve. Okay, chalo. Let us start. So first combination they have given is pound to rupees. This they have given. So pound to rupees is 104.0215 and 104.5505. So this is the bid rate, this is the ask rate. Okay, bid rate and ask rate for the first equation. Then second equation is dollar to pound. So dollar to pound is given 0.7155 and 0.7195. Then the third thing they have given is 100 yen to dollar. 100 yen to dollar, 0.8695 and 0.8710. So the ask rates we have identified, okay, on this side. And what they want, okay, what they want is, they want 100 yen as compared to rupees. So yen should be on the numerator, rupees should be on the denominator, and all the other currencies have to be cancelled off. Okay. So let us start. First equation, rupee is already here. If you see here, I am here. Rupee is already down. So I'll write down pound upon rupees cross rate multiplied by pound. I have to cancel it off. So dollar upon pound, it is already getting cancelled, into 100 yen is up. See, wherever required, we have to take the reciprocal. Okay, wherever. Now this is an easier question. There is no reciprocal. There is no mixing of ask and bid. It is straight away. Okay. So now write down the rate. So pound upon rupees. So pound upon rupees ask rate. So ask rate is 104.5505 into dollar pound ask rate 0.7195 into yen to dollar 0.8710, all ask. Why? Because we want to buy and therefore bank will sell. So remember, the bid rate and ask rate are from the bank's point of view. It's not from our point of view. Bank's point of view. Bank is selling, we are buying. So selling rate, ask rate. So multiply. So 104.5505 multiplied by 0.7195 multiplied by 0.8710. So you get the answer 65.52. So 100 yen as compared to rupees 65.52. So let us see whether we have the option 65.52. Answer is option C. That is the answer, 65.52. So if you observe this examination, the MCQs were on a tougher side. Okay, it happens, it's an odd kind of a thing, that lot of calculation and lot of complex calculations, but yes, it happens. So be ready. Sometimes it may be an abnormal kind of scenario. Okay, not in June, don't worry. In the coming June, it won't be such tough situations. And the last question is RBI, easy question now. If the RBI intends to reduce the supply of money to bring down inflation, if inflation has to reduce, what should the RBI do? Easy. If inflation to be brought down, supply of money to be reduced, and that means the banks should be given less money to lend. So bank has less money to lend. That means bank will have more money to keep it with the RBI. So increase the CRR. Correct, makes sense. If CRR rises, so bank will have less money to lend. So first option looks good. Decrease SLR. No, because SLR goes down, bank has more money, so supply rises. Doesn't match. Buy government securities in the open market. Again, if government buys the securities, they are again putting money in the market. So supply of money will rise and lower the bank rate. People will borrow more. So correct answer is A. Correct answer is A. Increase the CRR, reduce the supply of money and control the inflation. So that is the answer of 10th question. That is the last MCQ of this paper. So this was the June 2023 old pattern. And now we'll go to June 2023 new pattern. Okay. Yes, so now after the June 23 old pattern, okay, so let us go to June 23 new pattern. Okay, it's a pattern which is right now going on. So initially they continued with the 10 MCQ policy, which later on they increased to 15 questions. Okay, so let us see what June 23 gave us and how we are going to tackle with the June 23 papers. Okay, chaliye, let us start. So first question is, the company is evaluating the investment in the project which requires 39 lakh of expenditure, that is outflow. The company expects annual investment of cash flows. Annual inflows are 6 lakh per annum indefinitely, perpetuity. The discount rate which applies is 14%. What will be the base NPV? One of the easiest questions to be asked. So base NPV. Okay. So base NPV, the formula is very simple. So So base NPV is your cash inflows upon rate, PVIF. Okay, but normally if PVIF is given, then we have to consider the number of years. But in this question, what they have given? Indefinite. Okay, they have used the word indefinitely. So simply upon your rate, that is WACC, the expected rate. So this will give you the inflows DCF and minus investment, that is your outflows. As I said, one of the easiest of questions ever asked. So inflows are 6 lakh upon the rate is 14%. That is your DCF, that is present value of inflows, minus investment, that is 39 lakh. Okay, so on the calculator, simple 6 divided by 14%. So it comes to 42.85, and from this you subtract 39. So answer comes to 6.85. Okay, sorry, 42 minus 39, sorry, my bad. So 42 minus 39 is 3. Okay, so answer is 3.8586 lakh. So option B. Okay, so 6 upon 14. Okay, 6 upon 14%. So 6 divided by 14%. So you get 42 minus 39, that is 3.8586. So option B, easiest. This is one of the easiest questions asked. Okay, let us go ahead. Question number 2. This is also easy. So company is considering 4 projects PQRT with the following information: expected NPV given and standard deviation given, and identify the least risky. So least risky project if coefficient of variation is used. See, normally we take standard deviation to measure the risk, but coefficient of variation is a better method because it compares the risk as well as returns. So what is the formula of coefficient of variation? The formula of coefficient of variation is standard deviation upon mean. So mean is the expected NPVs. So standard deviation is given here, 8,000 divided by 1,20,000. Okay, so for all the projects, we have to find out coefficient of variation, and wherever coefficient of variation is the lowest, that is the least risky. That is what they have asked. So we have to find out where the coefficient of variation is the lowest. So in the first project, it is 8,000 divided by 1,20,000. So in the first, coefficient of variation is 0.06. Okay, 6666 it goes, so 0.67. In the second project, it is 20,000 divided by 1,60,000. So it is 0.125. In the third project, it is 24,000 divided by 1,40,000. So 0.171. And in the last, it is 28,000 divided by 1,80,000. Okay, so this is 0.15555. So what we want the lowest, which is the least risky. So answer is 0.067. So the least risky project is project. So in the question paper itself there was a misprint. So here they have written A, B, C, D. Here they have written P, Q, R, S, T, but option 1. So option A, the lowest is project P. So simple, we know the formula of coefficient of variation. So coefficient of variation is standard deviation upon expected values. So simpler division, lowest is the least risk. So again, a easy question considering our exam. Then third question, pure theory. It is based on digital finance. So which of the following is not a component of digital infrastructure? Okay, which of the following is not a part of infra? Now let us see which is not a part of infra. So now suppose API. So API and integration. So basically what they do, they help in connections. Okay, they help in establishing connection between systems. So it is a part of infra. If you say cloud services, so cloud services are used for storage. So again, it's a part of infra. If you consider as internet is a base. Without internet, all these things will collapse. So internet also is a part of infra. But what is not a part of infra is stable coin, because stable coin is a type of cryptocurrency. Okay, it is a type of cryptocurrency which is traded. It is not a part of infra. So question is, which is not a component of digital infra? So answer is stable coins. Simple. Okay, next question. A portfolio manager managing portfolio having beta of 1.5 whose current market value is 12 crore. This is the value of his portfolio. It is expected that the markets are likely to correct downwards, that means they will fall, and hedging is needed using futures. So original has portfolio of 12 crores in the cash market. To hedge it, they are planning to go in the futures market. And currently Nifty futures are quoted at 8,000 points, and underlying that is your 100 units is your lot size, and the investor wants to hedge 100%. The portfolio manager wants to hedge 100%. See, it's a manager's, you can say, decision how much to hedge. So somebody who is very conservative, they may say I'll hedge more than 100%. Somebody who is more risk taker, he may say I will hedge say only 80%. But somebody who is balanced, he say okay, neither not more not less, 100% full hedging. So question asked is, what is the number of Nifty index contracts? How many contracts to be sold? Formula is very simple. So number of contracts. This is also one of the frequently asked questions, number of contracts. So number of contracts is his portfolio, whatever his portfolio is, into beta, that gives you hedge ratio, divided by the future. In this case it is Nifty. What is the price of Nifty? Multiplied by lot size. And since he wants to hedge 100%, so in the numerator we say 100% hedge. In some question, if they say that okay, he wants to hedge only 80%, then into 80%. In some question they ask hedge 125%, so numerator 125%. Okay, so now we put the values. So portfolio is of 12 crores. So 12 crores multiplied by beta is 1.5. Okay, values are in crores. And numerator, okay, so numerator is 8,000 into lot size, that is 100. So on the calculator you do 12 crores, 12 crores into 1.5 divided by, so answer comes to 225. Simple calculation, answer comes to 225, which we have option C. So how many contracts to be taken? 225 contracts to be taken for a 100% hedge. So formula, number of contracts is portfolio, that is how much he has invested, into beta, that is degree of risk, into 100%, that is overall hedging needed for him. He wants to hedge entire thing upon the futures contract and lot size. Simple formula. Put the formula, put the numbers, get the answer, done. Easy. So this question paper seems to be easier than the earlier one. Okay, so good for us. Okay, question number 5. So Mr. Gog is a foreign forex dealer in India. Rates of rupee and euro in international market are given with respect to US dollar. So 1 rupee is equal to USD 0.012 and 1 euro is equal to USD 1.117294. What will be the direct quote of euro to his customers? And he is in India. So he is in India and therefore he wants a direct quote with respect to rupees and euro. Okay, nice. So basically what he wants, okay, what he wants is euro upon rupees. That is what he wants. Okay, so euro upon rupees. And what is given is rupee upon dollar is given, and euro. Okay, just a sec. What is given? Let me check. Yes. So euro upon rupee is given is equal to rupee upon this, and we want rupee on the denominator side. Okay, chal. So let's not rush ahead. Let's first put the given information. See, sometimes what happens is we just have the first few questions very easy. Correct. First four questions were easy, and then suddenly we will overconfident and we directly go to solve the answers without just understanding what is given. Correct. So this is a common error. Means like I was confident that okay, I got the first four. Let us directly go. So have patience. This overconfidence also may lead to mistakes. Correct. So I just give an example that how overconfidence may lead to mistakes as well. So first we'll write down the given information. So rates of rupee with respect to US dollar. Okay, so what is given? Rupee upon US dollar is given 0.012572. This is given. Okay, this rate is given, rupee to dollar. Then second rate is given, that is euro to dollar. So 1 euro, sorry, okay, euro to dollar is given 1.117294. These are the given rates. And what they are asking is a direct quote. Okay, so what they want is they want this euro upon rupees is equal to euro upon dollar into dollar upon rupees. So we want euro in the numerator, so that we manage, and rupee in the denominator, so we have to inverse. So euro to dollar as it is 1.117294 multiplied by, so here see here it is given rupee at the top, but we want rupee at the denominator, so 1 upon 0.012572. Simple division. So let us do 1.117294 divided by 0.012572. So answer is 88. Okay, it comes to 88.872. 88.872. Let us see whether we have this answer here. Yes, option B, 88.872. So check here what we did. First the rates were given, so we wrote it in a fraction, right? Okay. Then what they wanted is direct quote. So direct quote means euro should be 1 and rupee will be fluctuating. So something. So 88 for example, just, and therefore the equation is created euro upon rupee. So euro is in the numerator, rupee in the denominator. So we adjusted the formula accordingly so that dollar will cancel being the common currency, and what remains is euro and rupee relationship. Okay, so again straightforward, but first always write the given information so that it helps and the chances of making mistake reduces. Okay, that is question number 5. Now question number 6, straight theory question. Let us see. Plain vanilla, actually both the words have the same meaning. So vanilla also means a plain without any difference, can say without any customization, a plain contract. See, vanilla flavor is the basic flavor of an ice cream. That's how the word is derived. vanilla ice cream, the basic. And then there are other flavors. So vanilla is called as plain. So vanilla interest rate swap means what? That is the question. Now we have learned in derivatives that swaps are transactions where we exchange, and if it is interest rate swap, so interest rate swap is fixed versus floating. Basic concept. If it is currency swap, then currency versus currency. Interest swap, interest fixed rate versus interest floating rate. That is the basic answer. Now let us find what the options are given. Okay, let us find the options. So first option is fixed to fixed. Okay, first option is fixed to fixed. But then there is what is to be swapped? What is the interest rate swapping here? So obviously first will not be the correct answer. Then fixed rate to floating rate. Yes, so this seems to be valid. Floating to floating, again nothing to swap, and currency. So currency is different from interest, and therefore a plain interest vanilla, that is basic, is swapping off, swapping off fixed rate to floating rate. Floating to fixed, fixed to floating. That is the answer. Fixed to fixed, both are same. Floating to floating, both are same. Currency different from interest rates. And therefore right answer is option B. Then next one. An option's theoretical value increases by 1.75 if the interest rate is decreased. So value of an option is increasing if interest rate is decreased by 1. So again, this is the question is related to option Greeks. The question relates to option Greeks. So option Greeks are your delta, gamma, which is change in price of the underlying asset with respect to option price. Then there is theta, which is change in option price with respect to time period. Then there is vega, volatility, and interest rate is connected to rho. Okay, so obviously because there is no time value, so option C and D will be gone. So because it is interest rate, then it will be rho. But again, the option value rises when interest rate falls. That means they are going in inverse relation. And when this happens, it is always a put option. If both go in the same direction, see, these are just common sense tricks to remember. See, there is a logic, there is a concept which is for the long answers. Here we are talking of MCQs. So for MCQs, a quick memory, quick tricks, what we can say, that a question is interest rate, so rho. But if you're confused in call and put, then if there is inverse related, you say put option, direct related, call option. As simple as that. Just for quick memory, nothing else. Then the intercept of the security market line on y-axis. So just remember the diagram of security market line. So what is y-axis, what is x-axis? That is what is asked. Okay, so y-axis, if you know the diagram, then you immediately know the answer is A. Okay, because y-axis is RF. The slope is risk premium. Okay, the slope of the SML is risk premium, and the x-axis, okay, x-axis is the beta. Okay, x-axis is the beta, that is the risk element, and y-axis is the risk-free rate. So answer is risk-free rate, option A. Finished. 1 minute if you know the answer. Next question. An investor is considering an investment in mutual fund with 2% load, and considering an investment, you're entering the market, so it is entry load. As another alternative, she can also invest in bank deposits. So it's a comparison question whether mutual funds, what ROI versus bank deposit, FD, that is 8% interest. Her duration is 4 years, horizon time. What should be the annual rate of return on mutual funds, so that she prefers the investment in the fund to the investment in bank deposit. So basically what we have to do is, we have to find out the returns on bank deposit, and we have to compare that with mutual funds. So basically what the question is, that how much the mutual fund should earn so that it is better than the bank deposit. That is the question. So bank is giving you 8. Okay, bank is already giving you 8. So question is how much mutual fund should give you so that it is better than 8% over 4 years. Duration is 4 years, obviously compounding 8 years. You have to go ahead. And there is an entry load of 2% as well. That means if you put 100 rupees, then out of 100, 2 rupees will be gone as charges. So only 98 will be invested. Okay, only 98 will be invested. Okay, sure. So first we'll find out what is the rate on bank. Okay, again, slightly, I'll not say tough, but slightly difficult than the earlier questions. Okay, so now if you assume a principal, okay, if you assume a principal of rupees 100 and you're putting this in a bank at 8% per annum for 4 years compounding. So total how much you're going to get? So 100 plus 8% first year, plus 8% second year, plus 8% third year, plus 8% fourth year. So total amount at maturity, how much you will receive back after 4 years is rupees 136.05 approximately. So this is your amount at maturity if you invest in bank FD for 4 years compounding. Now the same 100 rupees, this has to be constant. So mutual fund, you are investing rupees 100, but there is an entry load which is given 2%. That means expenses will be cut. So you put 100 rupees, but your actual amount invested will be 100 minus 2, that is 98 rupees will be invested. Okay, for 4 years. So let return on mutual fund say be R percent, for example. You can assume X also. And therefore, what they want is returns of mutual fund. Okay, returns of mutual fund should be better than bank. So what we are going to do is we'll try to find out returns of mutual fund are more than bank FD. So how much goes into mutual fund? So mutual fund actual investment is 98. Rate, this we have to find out, raised to the power 4. This should be more than 136.05. This is what we are getting on a bank. So we have to get more than this amount. That is what the target is. Okay, so now we have to solve the equation. So 1 plus r raised to the power 4. 98 will go on this side, divided by 98. So this is 1.3883. For higher accuracy, we have gone to 4 decimal places. Then here it is raised to 4. So to remove this, we square root both sides. Not just square root, the fourth root. The fourth root of 1.3883. But luckily, if you do square root once, it is raised to 2. If you do it twice, it will be raised to 4. So what we have to do is 1 plus r, okay, on your normal calculator, 1.3883, press square root sign once. Okay, so 2 is gone. Press square root sign twice. So see, normally what we do, when you square double, then double ka double 4, and you have to come back. So you press square root once, so it is 2. You press square root 2, it is 4 times. So when you do that, so the answer comes to 1.0855 approximately. You try on your calculator. What I have done? 1.3883. I press square root sign twice, because once I do 2 power and we want 4 power, so twice. And therefore R 1 is cancelled, so R is greater than 0.0855. So if you consider as percentages, so 8.55%, this is the minimum. 8.55% minimum mutual fund should earn. Now let us see whether 8.55 is one of the options. Answer is yes, sir. It is option B. So how much mutual fund should earn? 8.55%. And why they should earn more? Because of that entry load, only 98 goes into the investment bracket. So to beat the bank, we have to earn more than 8. So one thing was sure, answer has to be more than 8. Okay, so all the options are also more than 8. So correct answer is option B, 8.55%. And the last question, 10th one, is which of the following is not a part of market risk and why? Let us see. First is equity risk. Yes, obviously equity is related to market share price going up and down. Inflation, obviously yes, inflation is related to market and economy. So downgrade risk. And this is something different. So answer is downgrade risk because it is related to credit rating. It is related to credit rating of a particular debt instrument. It is not related to overall market. Inflation will hit overall market. Equity will affect market. But downgrade risk, it is specifically to credit rating. So this is not a market risk. This is credit risk. So the correct answer is the odd man out is option C. Okay, option C is the odd man out. That's it. So this was a much easier paper as compared to the earlier ones. Okay, so that was the exam paper of June 2023 and new pattern. You observe new pattern is easier than the old pattern. Chale. So now let us go to December 2023. Yes, so now we continue our journey into all the MCQs. So we have reached December 2023 old pattern. See, when the new pattern came, so for 2 attempts, that is June and December, both the patterns were working parallelly. That means June 23 old and new patterns were running, and December old and new. And from 2024 the old pattern was discontinued and the new pattern only remained. Okay, so for December 2023 again there are 2 papers. One is for old pattern, one is for new pattern, but MCQs are MCQs, practice is practice. We'll be doing everything. Okay, so coming to December 2023. So first question, an investor has collected the following information about 2 securities A and B. Expected returns 15%, 18%, standard deviation 18 and 22%, beta given 0.9 and 1.4. The variance of returns of the market index is 225 percentage square. The correlation coefficient between the returns of A and B is 0.75. So here there is an information overload. In some questions they give very less information and we have to find our way from this side or that side. And in some questions they give us so much information that we are confused what is to be used and what is not to be used. So it's about how we conduct ourselves, how we, and normally question 1 they'll try to rattle you. Okay, question 1 they'll try to say frighten you, but we don't have to do that. Okay, so if you read the question and you feel that okay it is something not very comfortable, so what you do, you immediately go to the next question. If second question seems uncomfortable, you go to the third question and you see all. So basically when you start solving, our first job is you read all the MCQs. Okay, you read all the questions and identify the easier ones. You start with the easier ones, that will give you confidence. And confidence is the key. Okay, the more confidence you have, correct, the better your problem solving ability, the better your mind works and the better solutions you give. And obviously our target is exemption 60-70 marks, and you will definitely go there. So first go through the paper and get the confidence to start on a positive note. Okay, but fine. So we'll go in the same sequence. Okay. So investor has two things, and the systematic risk of portfolio. So what are they asking? Okay, they are asking the systematic risk of portfolio of two securities is equal to. That is what they are asking. Portfolio overall, A and B. And the correlation coefficient is given, A and B is 0.75. So basically what we want, portfolio beta. Okay, we want portfolio beta, portfolio variance. That is what we want. So let us see again what all information and how we can go about it. Okay, so one more information they have given, that the two securities are in equal proportions. So their weightage is also given, and equal proportion means they are in the ratio 50-50. Okay, ratio is 50-50. So what we'll do is, step 1, we'll find the weighted beta. Okay, so what we'll do, we'll find that the weighted beta of the portfolio, because the weights are given. So formula is summation beta into weights. So beta of first is 0.9. So 0.9 into weight is 50%, plus second is 1.4. So 1.4 into 50%. Okay, so solving the equation, so 0.9 plus 1.4, 50%. Okay, so overall portfolio beta 1.15. This is the beta of the portfolio having 50-50 weightage. So first step is done. And now what they want is, they want a systematic risk of portfolio. So systematic risk of portfolio, there is a direct formula. So systematic portfolio risk, systematic portfolio risk, a direct formula is beta of the portfolio square into market variance. So beta of the portfolio is 1.15 square into market variance. So variance of the market is given 225 into 225. Okay, into 225. So on the calculator, 1.15 square into 225. So answer is 297.56. 297.56. So we have option C as the winner. Okay, we have option C. So not a regular kind of numerical. Okay, not a normal kind of numerical, but yes, so institute will ask something abnormal. Sometimes they will ask, they have to ask, and they will. So if you see the question and you find that, okay, I don't remember this formula, so it's okay. You can just go ahead and look for the positives. Second question. The current market price of a share of Thomas is 500. So current market price, that is the spot price, is 500. Within a period of 3 months, the maximum and minimum price is 600. So the moment you see these two things, so we know that they are talking of binomial model. Frequently asked question, options, pricing, binomial model. What should be the 3-month call option under risk neutral method value of call option? This was asked in one earlier paper also. So we have to find out the value of call option. And if the strike rate is 550. Okay. So how to go about it? First step is you find the probability of increase, decrease. Okay, so first step is we find the probability of increase, decrease. And they have also given e raised to the power 02 value is given. Okay. So let us go to the calculation part. Okay, so step 1, probability of increase. What is the formula? Formula is spot into e raised to power RT minus low price upon high price minus low price. Okay, so therefore, so what is the spot price given? Spot price is given as 500 into e raised to, they have given 1.0202 minus low price is 300 upon high price is 600 minus 300. So solving into 1.0202 minus 300 divided by 300. So probability is 0.70. So probability of increase is 0.70, that is 70%. And if probability of increase is 70%, so what is the probability of decrease? Obviously 0.30, that is 30%. So first step to finding the value of option is find the probability of increase decrease. Now we are talking of call option. So call option, if the price rises above the strike price, we will exercise the option. But if the price is below, okay, we are bullish, so if the price is below, we will let the option lapse. And when option lapses, the gain is 0. If we exercise, then there is a positive gain. So using this concept, so what is the value? Okay, before going to the value, what is the expected payoff? Let us see what is the expected payoff. So expected payoff, there are two possibilities. If the price becomes higher, so higher price is 600 minus strike price. Strike price is 550. And what is the probability of high price? Probability of high price is 70%. Plus, if the price is low, what is the lower price? 300 minus, so here obviously it cannot be negative, so it will be 0. Probability is 30%. It cannot be negative, so it will be 0. So if you solve this equation again, so 600 minus 550 into 70%, and therefore expected, okay, expected payoff is 35. This is not the final answer. Okay, so value of option as per binomial is expected payoff upon e raised to the power RT. So expected payoff is 35 upon 1.0202. So answer is 34.31 approximately. 34.31 rupees is the value of call option, 31.31. Now let us see whether this answer is in one of our options. 34.31, yes, option B. So binomial model, step 1, find probability of increase decrease, and then depending on options, if it is call option, then higher price exercise, lower price lapse. If it was put option, then higher price lapse, lower than this exercise. So you have to read the question. So in this question, it was asked for call option. Therefore, higher price exercise, lower price lapse. If it was the ulta put option, then lower price exercise, higher price lapse. So read the question accordingly to the calculations. Okay, that was question number 2. Now question number 3. Okay, let us go to question number 3. An investor has put 50,000 in a mutual fund scheme on 1st April. The capital gain and dividend is 3 rupees, which was reinvested. That means they did not withdraw the dividend and capital gain, but it was reinvested, so they got additional units. See, there are two types of schemes in a mutual fund. One is called as the payout scheme, dividend payout. So whatever dividend is declared, we get the money in our bank account. That is a payout scheme. Second is the dividend reinvestment scheme. That means whatever dividend is declared, they don't give it to us in a bank, but the same dividend amount, they give us additional units. Means just to have a comparison with shares. So when a company declares dividend on shares, I get the money in bank account, but instead of doing that, whatever dividend amount, if instead of giving me money, they give me extra shares. The same logic in mutual fund, that dividend reinvestment which is given in this question. So it was reinvested at the end of the year at a NAV of 25 rupees. So they got additional units. So investor had total 2,800 units at the end of the year. So question is, what was the NAV at the start of the year? Okay. What was the NAV at the start? Yes, so interesting question. So when I say interesting, that means it's not straight away easy, but we have to go around it. Okay. So let us start. Let the NAV. So one figure is missing. Let the NAV at the start. This is what they are asking. Be rupees X. So NAV is the value of 1 unit. And how much we invested? We have invested, investment amount is given. We have invested 50,000 rupees. Okay, we have invested 50,000 rupees, and that time the NAV was assumed as X, and therefore how many units? So number of units received, amount 50,000 upon value X. 50,000 upon X, these many units were received. Okay. Okay. Then what happened is they declared capital gain and dividend. But what they did, so if number of units are this, dividend plus capital gain is rupees 3 per unit. So per unit, the fund has declared 3 rupees, and we have how many units? This much. So total dividend. So per unit is 3. So 50,000 into 3. So total dividend will be 50,000 into 3. So total dividend is 1,50,000 upon X. This was the total amount the investor should have in his bank account if it was a payout. But it was not a payout, it was a reinvestment. That means dividend was reinvested at NAV. This is given at NAV of rupees 25. Okay, this was reinvested at a NAV of rupees 25. That means investor got extra units. So number of extra units is equal to, this is the amount 1,50,000 upon X. So this amount was invested at a NAV of rupees 25. So number of units, solving the equation, 150 upon 25. So number of units 6,000 upon X. I told you it was not a straightforward question. We have to just find our way. That's what we're trying to do. So original units 50,000 upon X. Additional units 6,000 upon X. And in the question they have given total units at the end. Total units at the end of the year. This data is given 2,800. Okay, 2,800. So finally we have to equate. Therefore, original were 50,000 X, 50,000 upon X plus additional 6,000 upon X is equal to 2,800. So X is the common denominator, so 56. So 56,000 upon X is equal to 2,800. Solving the equation, X, that is the original NPV, so 56,000 upon 2,800. So the value of X finally is rupees 20. So what was X? It was the NAV at the start. It was NAV at the start, rupees 20. Now let us see whether 20 is in our option, because we have solved so much things and now it must be there in our options. Okay. Yes. So option C, 20 rupees. So complicated. Okay, so so far all three questions took time. Okay, question 1, question 2, question 3, all three. Okay, not so straightforward. It has taken some good amount of time. Now let's hope question 4 is better. So Mr. Goa is a forex dealer in India. The rates of rupee and euro in international market are so and so. What will be the direct quote? Okay, similar question was there in earlier paper as well. Okay, so now what we have to do, first we write down the given information. So given information, so rupee and US dollar. Okay, so what is given? The rupee upon US dollar is equal to 0.012468. Okay, and euro and US dollar. So second information given is euro upon US dollar is equal to 1.092694. So what we have done, we have written the given information in a equation format for cross rate. Obviously, purpose is cross rates. What is the direct quote of euro? So direct quote of euro, that means euro should be the numerator. So euro with respect to rupees. So euro upon rupees is equal to, this is what we want. So euro upon rupees is equal to, see here rupees is on the numerator, so we have to get it down. So dollar upon rupees, reciprocal, multiplied by euro upon dollar. So this is as it is, and this we had to reciprocate, because rupee was upper, we had to bring it down. So reciprocal. So this is equal to 1 upon 0.012468 multiplied by 1.092694. So multiply, so 1.092694 divided by 0.012468. So 87.63. Do we have 87.63? Yes, sir, we have 87.63. Option C. So exact similar question asked in earlier paper as well. So see, when we are solving MCQs, you will be observing that there is a pattern. Few questions are repeated, few type of questions are repeated. So we know which type of questions, how to understand, how to go about it, and so on. Okay, so when we study all the questions, we identify the patterns, and patterns help us in getting maximum marks. So that was question number 4. Now question number 5. Okay, let us come to question number 5. A company has been evaluating investment in a project, requires 40 lakh expenditure, that is investment, and the company expects investment to provide cash inflows of 9 lakh every year indefinitely. Okay, the business risk requires 15% rate. Okay, and the base NPV is simple, base NPV. If you remember, similar question was asked earlier, easy question. So base NPV is inflow upon rate minus investment. So inflow is 9 lakh, rate is 15%, minus investment is 40 lakh. So 9 divided by 15% minus 40, 1 minute answer 20 lakh. Finished, 1 minute. Base NPV 20 lakh. Done. Option B. Chalo, let us go ahead. Next question. The stock of Anos Limited face value is 10, is quoting at 500 on the National Stock Exchange, and 3-month futures is quoting at 510. The borrowing rate, opportunity cost 15%. What is the theoretical price of 3-month options? Sorry, futures contract. So they have given the spot rate, they have given the opportunity cost, they have given the duration 3 months, and theoretical. That means this question is related to cost of carry model. This is related to cost of carry. So cost of carry model, there is a basic formula, then you can use using continuous compounding, that is e raised to the power r. Okay, so they have not given any information related to e raised to the power, so let us go with the basic formula. Okay, so what is the basic formula? Futures price theoretical is equal to spot rate plus spot into opportunity cost into duration, and there is a dividend also. Okay, first class, minus DPS, this is the formula. So what is the spot rate? Okay, the spot rate is 500 plus spot into 15% into duration is 3 months, so 3 by 12 into DPS is 25%. So this 25% is always on face value. So 10 is the face value and 25% of 10 is 2.50 dividend received. So on the calculator, 500 15% plus spot rate minus dividend. So answer comes 516. We have a winner, option B, 516.25. Direct question. Theoretical cost of carry. So that there was a hint, theoretically. See, practically it is continuous compounding. So we say e raised to the power RT. Theoretically it is normal rate, normal formula, easy answer, 516.25. Done. Next question. The portfolio composition of Mr. Sanu. Equity 120 lakh, cash 40 lakh, total is 160. The beta of equity portion is 0.85, and we know beta of cash is always 0 because cash in hand has no market, no equity risk. And the current Nifty is trading at 4261.5, and the multiple attached to Nifty is 100, that is lot size is 100. If Mr. Sanu purchases 23 contracts, so in the last exam they had asked the question how many contracts to buy and they had given beta. Here they want us to find, so find his portfolio beta. Ulta hai. So last time beta was given, we have to find number of contracts. Here number of contracts are given, we have to find the beta value. Okay. So first and foremost, what we'll do is we'll find the overall beta. Okay. Now beta of equity portion is given 0.85. Okay. So beta of portfolio. Now portfolio has cash as well. So total is 160. So equity portion is 120 upon 160, that is weightage, and equity beta is 0.85, and cash is 40 upon 160, but cash beta is 0 because there is no market risk in cash, and therefore 120 into 0.85 divided by 160. So current beta is 0.6375. This is existing beta of both combined, equity plus the cash together in the weightage ratio 120/40 ratio, that is 3:1 simply. And the current Nifty is 4261, lot size is 100, and number of contracts, fine. So when such a question comes, there is a direct formula. See, we can go indirectly and so on and so forth, but let us go for a direct formula. So write down the formula. Number of contracts is equal to B1 means new beta minus old beta into the portfolio value upon the futures contract. So number of contracts is 23. This is given to us, and we want the new beta. Old beta we know 0.6375 into value of portfolio, that is 160 lakh, upon futures. So 4261.5 into 100, so 4.4 lakh 26,150. So basically you have to solve this equation. Okay, so if you want in lakhs, so 4 point, okay, because 160 lakh we have written, so 4.26150, okay, and into 23, okay, that is 98, and 98 divided by 160, okay, and plus 0.6375, okay, and solving the equation we get the value of beta, that is new beta is 1.25. Option D, value of beta is 1.25, solving the equation. So there is a direct equation if such question comes. Since some questions we know the process, we know in some questions that there is a, we don't remember simply, no matter how much we study practically. So in some cases we just have to remember the formula and get the answers. So one is a right way of doing it, which we do 90% of the times, but sometimes there is a trick method, a shortcut method, a memory technique where we get the full marks. Okay, let us go to the next question. Theoretical question now, no calculation. Buying a call and a put with the same expiry. Now this is, you're talking of option strategies. So buying call, buying put, same expiry, same stock, but different, this is the key, different strike price. So same expiry means same maturity, but different strike price. So the strategy is strangle. If the price was also same and expiry was also same, then it was straddle. It was a combination of 2 and 1. 2 call, 1 put, 2 put, 1 call. Then it would have been strip or strap. But what is here? 1 call, 1 put, different strike prices. So the moment it is different, the strategy is called as strangle. 1 minute answer finished. Next question. P and Q are two projects. P has a higher initial fixed cost and will make a profit of 10,000 for high sales and a loss of 4,000 for low sales. So possibilities. So it's a project. Okay, for a project, if everything goes fine, then 10,000 profit. If everything goes bad, then 4,000 loss. For Q, everything goes fine, 7,000 profit. Everything goes bad, still 2,000 profit. The probability of high sale is 60%. That means low sale is 40%. The expected value of perfect information. So this question is related to information. When it is without information, we go for probabilities most likely. With information, we go for a different approach. Okay, chali, let us solve. So first we'll solve without. Okay, we'll do some practice as well. So without perfect info. So without perfect info, what we do? We go with probabilities. Okay, so what are the name of the projects? Project P and Q. Okay. So for project P, if everything goes well, then there is 10,000 with a probability of 60%. Sorry, the probability of 60%. And when things go bad, then there is a loss of 4,000, probability of remaining 40%. Okay, and therefore P, the net result is under without, that is without perfect information, 4,400. Then for project Q, if everything goes fine, good, then high sales 7,000, probability 60%. If low sales, then still there is a profit, probability 40%. So 7, 6, 42, 42 and 8, that is 5,000. So if the question is asked only this much, that without perfect information, which project will be chosen, then answer is obviously Q. Okay, first part. Now, if you have the information with perfect, that is what they have asked in this question, with perfect information. So we know that sales are high or sales are low. We know that. So if we know that there are high sales, then project P is giving you 10,000 and project Q is giving you 7,000. So in that case, with perfect information, P would be obviously better in case of high sales. If it was low sales, then P has a loss of 4,000 and Q still has a profit of 2,000. So if it was low sales and you had the perfect information, then obviously Q was the winner. Here P is the winner. And now lastly, combining both with the probabilities. So finally P high sales, what is the probability? 60%, plus Q low sales, probability of 40%. So 10,000 60% is 6,000 and 2,000 40% is 800. So combining both, most likely 6,800 with perfect information. Okay, with perfect information. So let us see 6,800. So probability of high sale, the expected value of perfect information. Expected means using probabilities of high and low. So without also we solved just for practice. And with this information, we have solved with information perfect and without. That is the answer, 6,800. And next question is a direct question, theory. Which of the following is true? Systematic risk can be minimized by investing in many sectors. Okay, systematic is non-diversifiable. Okay, systematic is non-diversifiable. So this statement is false. Government securities are free from interest rate risk. Yes, government securities, debt market and debt market are affected from interest rate risk. So this statement is also false. The market rewards an investor in proportion to the unsystematic risk. See, market rewards are with respect to systematic risk. False. And systematic risk is independent of the industry to which the security belongs. So all the above three were false and therefore option D was the right answer. Okay, option D was the right answer. So that is the end of this paper, that is December 2023 old pattern. Okay, so now we go to December 23 new pattern. Lot of practice, but yes, concepts also we are discussing, Numericals we are solving slowly so that you understand and then you apply. And I'm sure you're also observing the repetition, the patterns, what questions are asked again and again, so that you are ready for the same questions with full confidence. Okay, so let us start the next paper, that is December of 23 new syllabus. Okay, so now one after the other we started with 2022. Okay, so 22 December, then June 23 old pattern, new pattern, December 23 old pattern, and now we come to the fifth paper, that is December 23 new pattern. Okay, so this will be the fifth paper we are solving. Afterwards we'll still have 4 papers to solve, so overall 9 papers, all MCQs we are solving in detail, slowly, step by step, with concept clarity, so that you are ready, you are fortified for scoring the maximum marks in the MCQs. Okay, so December 23 new pattern, question number 1. Okay, so now here they have started asking 15 questions. Till now, whether it was old pattern or new pattern, they were asking 10 MCQs. But from December 23 new pattern, they shifted to 15 questions. Okay. So question 1, a project of Robin Limited has net present value base NPV. So the moment we read the word base NPV, we know it is adjusted NPV question. So base NPV is given 1,50,000. The project has one financial side effect, borrowing power of 5 lakh, and indefinitely if the borrowing rate is 10% and the tax shield is 35%, what is adjusted NPV? So easy. So adjusted NPV, ANPV short form, is equal to base. Okay, base NPV, plus debt tax sheet. So base NPV already given 1,50,000 plus debt. So debt is 5 lakh into rate is 10% into tax shield is 35% upon 10%. So automatically 10 will be cancelled. So 5 lakh into 35%. So 175 plus 150. So 150 is base plus 175. So final answer 3,25,000, option A. Time taken less than 2 minutes and 2 marks. So imagine if you are able to solve correct answer out of 15, even if you are able to solve say 10, 11, and each question will take, suppose on an average, 3 minutes. So 11 right answers in 3 minutes each, that is 33 minutes. Let us add some grace period, 40 minutes. So in the first 40 minutes, you have already scored 22 marks. And in the remaining 2 hours and 20 minutes, you are going to get the remaining 50, 60 marks. So 50 plus first 22 or 40 plus first 22, you are definitely crossing 60. So definitely scoring an exemption so that your overall group aggregate is also taken care of. So plan your timing also accordingly. Do not use a lot of time for MCQs, because the next questions, that is big questions, require time and patience and a calm mind. So MCQs use all the strategies. Okay. Second question. Ebon Limited's earning per share EPS. EPS is 15. Growth rate G 5%. The earnings growth are expected to stay at this level. Okay, the payout ratio is 50%. Cost of capital K is 15%. What is the market price? Intrinsic value using dividend discount model, because they're talking of payout. So the word payout itself is a hint that dividend discount model we have to use. So what will be after 3 years? And the growth rate is constant 5%. And Payout ratio is constant 50%. Okay, nice. So there are three methods. One is a long cut. You go to dividend for each year, you discount it and so on. Okay. And then finally we had to have uh, terminal value also. So if the payout ratio is 50, what will be the market price of the share after 3 years? Okay, market price after 3 years. See the question again. After. They don't want the price today. After 3 years. Okay. So what is the formula? So formula is market price is equal to DPS1 upon K minus G. This is the formula we are going to use. And now since if you observe everything is constant, growth rate is 5% constant, EPS is also constant 15 rupees. And EPS will rise by 5%, payout will also, okay, ठीक. So we'll solve using both the methods. Okay. So now what is the question? EPS is 15. Okay. So see here. So year 1, year 2 and year 3. EPS and DPS. This is 50% given. So last year EPS was given 15. It will grow by 5%. So next year EPS is 15.75. This will again grow by 5%, and therefore second year EPS is 16.53754 approximately, plus 5% it will grow again. So third year EPS is 17.36, and the payout ratio is 0.5. So 0.5 into 15.75 is 7.875. Then 8.27 payout and 8.68. So this will be the dividend after third year, and this will also grow indefinitely. So after 3 years they are asking. So this will grow by 5%. So this will be 91.14515 approximately. 1516. So 91.16 to be precise. Okay, 91.16. Sorry, it is 9.116. My bad. I jumped a little bit ahead. So 8 point. So 9.11516 approx. And now the formula I told you earlier. Okay, formula is market price is equal to DPS1, that is next year, upon K minus G. So DPS is 9.115116 upon K is 15% minus growth rate is 5%. Okay, so solving the equation, answer comes to 91.16. This is the market price expected after 3 years. So whether we have the option of 91.16, yes. So we have option B, 91.16. Okay, that is question number 2. So dividend discount model, one of the easier questions. The next question is the expected return on portfolio. So expected return 16, and its variance with the risk squared. Okay, so risk squared is given 285 and risk tolerance is 60. So risk tolerance and degree of risk, they are inversely related. Higher the tolerance means the investor is ready to take higher risk for higher returns. So higher the tolerance, lower the penalty. They are asking the question of what is the risk penalty. Okay, so what is the formula? Risk penalty is equal to risk squared upon risk tolerance. This is the formula. Now risk squared is already given 285 upon tolerance, that is 60. So simple calculation, 285 divided by 60, 4.75, not even 1 minute. And later on, if they ask, not in this question, so later on, what is the expected return? So last step is expected return is 16. So from this we subtract penalty. That will be later on. I'm just telling you for the concept point of view. So later on 16 minus 4.75, so utility and all that. So right now, okay, right now the answer is straightforward. So 285 upon this. So 4.75 is penalty. This is asked. This is asked, we got the answer. Thank you. Okay, question number 4. The following particular relate to a mutual fund scheme. Investment in shares in ITES, that is information technology, and ES is enabled services. So invested them, it was at 28 lakh, and at that time on the date of purchase index was 1750, and today the index is 2950. Then the fund invested in infrastructure also, 15 lakh they invested. That time the purchase date index was 1375. Today the index has gone up to 2475. The number of units is 1.25. What is the NAV? What is the NAV? So there is a formula. Okay. So value of that particular portfolio, that particular area. Okay. So what is the formula? The investment. Okay, investment into valuation date upon purchase date. That is the formula of value of that segment. So if you consider value of IT, so IT is 28 lakh into 2950 upon 1750. Okay, so 28 into 2950 upon 1750. So today's value of IT and ITES is 47.20. Then infra, same formula, 15 into 2475 upon 1375. So 15 into 2475 upon 1375. So it is 27. So total value of both of them, you add them, plus 47.20. So total comes to 74. So total value 74.20. This is the total value of portfolio. And how many units there is? 1,25,000 units. So you divide this by 1.25 lakh units. You get the NAV 59.36. 59.36 is the NAV. Do we have the answer? Yes. So answer A. Option A, 59.36 is the NAV. So what the meaning is that they had invested 28 lakh. At that time the index was 1750 and index value has gone up. So obviously my portfolio value will go up. And therefore what we did, we found out today's value of portfolio divided by number of units. So we get NAV. Simple. Simple. Formula is just for calculation. The logic is easy, that we invested 28 lakhs then, but then the market was 1750. Today market is 2950. So obviously my 28 lakh value will go up. So today it became 47. My 15 lakh became 27. So NAV is updated continuously. So today's NAV will be based on today's values. Simple. Then question number 5. Now this is a direct question, no calculation theory. If the director of company who has access to inside information is unable to use the information, so inside means secret, undisclosed. Inside is undisclosed or secret. So he has secret knowledge, still he is unable to make profit. So this question is related to efficient market hypothesis, EMH theory. So what EMH theory says, that there is a weak form of efficiency which says market is aware of past data. There is semi-strong form of efficiency which says that market is aware of past and present published data. And there is strong form of efficiency which says that market is aware of undisclosed, even secret data. So if market is aware of secret data, so obviously market is ahead of you, so you cannot make profit. So where market is aware of secret information, inside information, answer is strong form of efficiency. And therefore concept question, if you know the theory, you know the answer. So correct answer is strong form of efficiency. Your inside information is of no use because the inside information is also known by the market. Market has already adjusted itself. So you can't make profit out of it. That is the theory of EMH, efficient market hypothesis, given by Farmer. Next question. So EL company has a beta of 0.8. Okay, it has a beta of 0.8 with BSC. Then each BSC futures contract is worth 100 units. Okay, they anticipate a bearish market for the next 3 months, has gone short hedging on 25,000 shares. The shares are presently traded at 100 rupees. 3 months BSC is quoted at 15,500. What are the number of contracts to be taken? Number of contracts to be taken if they want to hedge 125%. In earlier questions papers, they wanted to hedge 100%. In this, they want to hedge 125%. And number of contracts options are given. Okay. Okay. So number of contracts. Okay. So number of shares are 25,000. They are traded at 100 rupees. There is beta of 0.8. Okay, beta is to be taken for hedging 0.8 into 125% into 125% shares. Oh, next 3 months has gone short on shares of 25,000. Okay, there is some in the spot market. So shares of 25,000. Off, see the wording, shares of 25,000. So it's not 25,000 shares, it's shares of 25,000. So okay, so 25,000 into this upon lot size is 100. So 25,000 into 0.8 into 125% divided by 100. So how many contracts? Answer is 250 contracts. Answer is 250 contracts. Option B is the answer. Next question. Direct question concept. Buying and selling a call and put with same strike price and same expiry. Both are same concept question. Answer is straddle. If expiry is same but prices are different, then it goes to strangle. Okay. In case of strip, strap, such things, it's a combination of 2 and 1. 2 call, 1 put, 2 put, 1 call. Box spread, there are 4 different strategies. So answer is simple, buying and selling, call and put, a call. 1 call, 1 put, same price, same expiry. straddle. 1 minute, finished. Next question. When the trade opens on 1st March 23, the stock price of Rolex is 250, it rises to 260. The March call option on Rolex started at 25, it moved to 29. The delta of the call option, delta. So delta means again you are talking of option Greeks. So formula of delta is very simple. Okay, formula of delta is change in premium upon change in underlying asset. Underlying asset price. So what was the premium? Premium is 29.25. So 29 minus 25, that is change in premium, and price is 250 has gone up to 260. So price change 250 minus 260 minus 250. So this is 4, this is 10. So 4 upon 10, answer is 0.4. Finished. So what is the meaning of delta? Delta is the change in premium upon change in the price of underlying asset. Simple concept. Simple answer. Next question, security market line. So slope of SML. The slope of SML is always the risk premium. So risk premium is RM minus RF. So slope is always the risk premium. Okay, the horizontal axis is always RF. This is the risk, that is beta, and the slope is always RM minus RF, risk premium. Know the answer. 1 minute, full marks. Then again a theory question. Which of the following are the benefits of UPI? But see the question. Don't stop just here. Benefits of UPI. But for merchants, this last word students they miss, and then the whole answer goes wrong. So from the merchant point of view, see, benefits are for consumers also, benefits are for merchants also, benefit from government, banks, etc. So question is asked from merchant point of view. See, round the clock availability. This is mainly for consumers. This is mainly for the users. Single click authentication. Okay. Safer, secure, that is for the bankers. So for the merchant point of view, their best is in-app payments. This is the advantage from the merchant, that is shopkeeper, businessman point of view. Okay, so all the others are benefits, but one is for bank, one is for consumers, but the question is from merchant point of view. So merchant point of view answer is this is the best technology for merchants, in-app payments. Next question, again a theory question. In Porter's analysis, so Porter is basically, it helps us to find out the threats and the in a way external risk analysis. Which of the following is not considered, read the question, not an entry barrier? So threat of new entrants, entry barrier stronger, no threat. Okay, so let us see Porter. So product differentiation, it is an entry barrier. Switching cost, yes, from the consumer point of view, that they don't want to switch from product A to product B. There's a lot of inconvenience. Capital requirement, yes, it's an entry barrier because huge capital is a barrier. Low value addition, this is not an entry barrier. So product differentiation, definitely yes. Switching cost for consumers, yes. Huge capital is a barrier. So answer is, or rather what they are asking is which is not a barrier. So low value addition is the answer. Okay, then going forward, again a theory question. Okay, this was a good paper. Which of the following is not a digital asset? Not an asset. Website has copyrights and other things. So website is your asset. Stable coin, it's a type of crypto, it is your asset. Fintech technology, it is your asset. So what is not an asset is digital printing, because it is a process. It is a process, not an asset. And therefore answer is digital printing. It is not an asset. Okay. Next question. 90-day interest rate in USA is 1.85, and in UK it is 1.35, and the current spot rate is $1.6 per pound. The 90-day forward rate will be, now this is based on interest rate parity, IRP. This question is based on IRP. Okay. Okay, so now let us solve. Okay. So let us first write down the formula. So let us assume that we are in the USA. So formula is 1 plus RD upon 1 plus RF. So RD is rate in domestic, RF is rate in foreign, upon forward rate upon spot rate. Okay. Now the rate is given already for 90 days. They have not mentioned that 1.85 is per annum. It's directly a 90 days rate. If it was mentioned per annum, then we would have done into 90 upon 360 or into months, etc. Okay, so 1 plus in USA 1.85% in US upon 1 plus foreign, that is UK 1.35%, is equal to forward rate we have to find. Spot rate is given 1.60. Okay, so therefore solving the equation, so it will be 1.0185 upon 1.0135 is equal to forward upon spot, and spot is given 1.60. Multiply 1.6 into 1.0185 divided by 1.0135. So the answer comes to 1.60783. And do we have this answer here? Yes. So answer is C, 1.60. So interest rate parity, IRP. This is the formula. Substitute. The only mistake here is that this is already adjusted to 90 days. So again, do not do 90 upon 365. That one should keep in mind. Then next question. Zones Limited shares are traded standard deviation of company and market. Correlation coefficient R. What is the beta? Easy. It cannot get easier than this. So beta is equal to standard deviation of security upon standard deviation of market into R. So standard deviation of security is 6 upon 4 into R, that is 0.8. So answer of beta is 1.20. Okay, 1.20. Answer is ready. 1 minute and we are done. And the last question, 15th question. Company wishes to earn a real rate of return 10%. Inflation is 7. What is the nominal rate? This is capital budgeting using inflation. So again there is a direct formula. 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. Direct formula. So we want NR. Okay, so 1 plus NR, this is what we want. 1 plus RR, what is R? 10%. Into inflation 7%. Okay, so 1 plus 10%. Okay, let us see here. 1 plus 10%. Okay, so formula is 1 plus NR is equal to 1 plus RR, 1 plus inflation. So now 1 plus 10% is 1.10 multiplied by 1.07 is equal to 1 plus NR. Okay, so 1.1 into 1.07, whatever the answer, minus 1. So solving the equation, NR is 0.177, which is equivalent to 17.70%. Option B. Option B. Yes, so that is the end of this paper, that is December 2023 new pattern. So till now we have covered 5 papers. So now the next is the remaining 4 papers, that is June 2024, December 24 and June and December 25. So let's go ahead with the remaining papers. Okay, चलिए let's go. चलिए आगे बढ़ते हैं. So the next paper we are starting is the June 2024 paper. Okay, now June 2024 new pattern. So let us continue our MCQ journey. Okay, so the first question, a project of ZOBM ZOM Limited requires an initial investment of rupees 100 lakh and generates annual cash inflows of rupees 29.85 lakh for 5 years. If the risk-free rate of discount, okay, so basic rate of discount is 10% and the premium for normal risk is 13%. Okay, now this question is based on the concept of risk adjusted discount rate, RADR. So 10 plus 3, the normal risk. Okay, if the project was absolutely risk free, then they would have taken 10%. But there is some normal risk and therefore they have added 3%. So this is called as a normal risk premium. So now they are planning to discount it using 13%. What is the maximum premium for abnormal risk as well? That means normal risk they have considered and they have come up to 13, and now they think that there is some abnormal risk and therefore they have to add something more and to get the final answer. So what is the maximum premium? So they are asking us what should be this amount. What should we add to this 13% so that we get the actual rate? So what we are going to do is, first we are going to find out this figure and then automatically as a difference we will get the premium, that is the differential figure. And they also give us the hint, they are saying use the IRR method. Okay, so they are telling us what we want to find out, they are also telling us how to go about it. That means they are telling us to find the IRR. Now what is the meaning of IRR? It is the internal rate of return, and IRR is that rate where NPV becomes 0. This is the conceptual part, that IRR is that rate of return where the NPV becomes 0. And when NPV becomes 0, that means the total present value of inflow will be same as the present value of outflows. So when PV inflows, that is DCF inflows and DCF outflows are same, NPV will become 0. And they want us to find out that rate. And every year the cash inflows are same, and therefore what now we have to do? We have to simply find out, let us see, the present value of inflows at IRR will be same as present values of outflows. So outflows is nothing but your investment. So present value of inflows, so 29 is per annum in 29.85 into PVIFA. We don't know the rate, but we know it is for 5 years. And this will be same as outflows, and outflows are 100 lakh. So this we are equating with 100. Okay, and therefore PVIFA R percent 5 years is equal to 100 divided by 29.85. So 100 divided by 29.85, so that comes to 3.35. 100 divided by 29.85 comes to 3.35. So PVIFAR percent 5 years is 3.35. Now if you see the data given, 15% 5 years is 3.35. And that means what we have got, the project IRR is 15%. That means what we have got this normal risk 13%, abnormal risk total is 15%. And what they have asked us, from normal 13 to abnormal 15, how much we should go ahead? 2%. So the correct answer is, what should be the extra added? What should be the premium added from normal to abnormal? So normal was discounting using 13, abnormal risk is discounted using 15. So how much extra? 2% is the answer. Okay, so the answer to the first question is option B, that is 2%. Okay, so now let us go to the next question, that is question number 2. Okay, so now what this question is talking about, the company has a ROE of 18%. So ROE we also denominate using R, and a plowback ratio. So plowback here means the retention ratio. So retention ratio is denominated by the word B. Okay, the alphabet B in the Gordon's model. The market capitalization. So market capitalization is K or KE is 13%. If the coming years, that is future, earnings are expected to be 4 per share, that means they have given EPS 1, future earnings are 4 rupees. What price will the company's share sell in 3 years? So after 3 years, what should be the market value? So basically we have to find out the value of the share using dividend discount model. Okay, we have to use the dividend discount model to find the share. Now normally in case of dividend discount model, okay, the formula says that DPS 1 upon K minus G. G is growth rate. Now in this question, if you observe, they have not given the growth rate directly. Okay, but indirectly they have given the growth rate. So basically, how does a company grow? It's a very simple logic. How does a company grow? A company grows by reinvesting its profits. So whatever profit you have, you reinvest. You buy new machines, you expand and you grow. You reinvest, you grow. And therefore, one of the versions of growth rate is you reinvest. So reinvest means flow back. That means B. Okay, you reinvest the money and then you earn profit on it. That means a formula of growth rate is B into R. So as per the Gordon's dividend model, the denominator, if you remember, is K minus B into R. So B is retention, R is your ROI. So you retain the profit and you earn money on it. You retain the profit, you earn money on it. In simple language, you grow. And therefore growth rate is indirectly given here. So B is 50% and R is 18%, and therefore the growth rate is 9%. Okay, so this is a different way of giving the growth rate. Normally they directly give that it will grow by 7%, 10%, 4%, etc. whatever. But in this question they have not given, so we have to find out. So using the concept of Gordon's model, okay, dividend growth model, so G can also be calculated using B, that is retention, into R, that is ROE, return on equity, which is given. Great. So now we have got G, now we have got the EPS. So in short, we have everything to find our final answer. Okay, so the most important part in this question is finding the value of G, that is growth rate. Okay, so now year 1, year 2, year 3, then EPS is given. So EPS is 4 rupees. DPS. So if retention is 50%, so payout will also be 50%. So DPS will be 2 rupees. And there is a constant growth of 9%. So if first year it is 2 rupees, so second year DPS will be 2.18. Then third year DPS will be 2.3762. That is third year DPS. And we have to find the price after 3 years. So what we do, we know that we find the DPS of the next year, so which is 2.59. Okay, DPS is 2.59. 3 years are done. So we have this value. So the formula, market price is equal to DPS of the next year upon K minus G. This is the normal formula. And therefore DPS is 2.59 upon K. K, that is KE, is 13% minus G, which is 9%. And therefore if you do on the calculator, 2.59 divided by 13 minus 9, that is 4%. So you get the answer. So market price is rupees 64.75. So important point in this question is identifying the growth rate. So let us see the answer. 64.75. Yes, 64.75, option B. So first question was on capital budgeting, that is risk adjustment. Second question is equity valuation using dividend discount model. Okay, let us go ahead. Third question. The expected return on portfolio is 15%. The variance of return is 280% square. If the investor's tolerance, okay, so tolerance here means the risk tolerance is 70, what will be utility? See, what is the concept of utility? So utility is basically your expected returns. Okay, we are talking simple language. Your expected returns minus the possibility of risk. So utility is something which will give you, from the economics point of view, which will give you satisfaction. Means, for example, if I write a paper, okay, if I write an SFM paper and my expected marks are say 70, and then somebody asks me, okay, your expected marks are 70, but what if you do some silly mistake? What if one of the MCQ goes wrong? So I said, okay, there is a risk possibility of 10 marks. So 70 is what my expectation, but there is a risk penalty because of my silly mistakes. They will cut my marks. So indirectly it's a penalty, and therefore 70, yes, that is what I expect, but I am also used to doing silly mistake. So they will cut 10 marks for silly mistake. So what is my utility? What will make me happy? 60 marks. 70 minus penalty. A simple analogy, a comparison to understand the concept of utility and penalty. Okay, so now the formula is very simple. So question is, what is utility? So for finding utility, we have to first find risk penalty. So the formula of risk penalty is equal to, okay, the variance of return, that is risk square. So variance of the return upon tolerance. See, higher the tolerance, lower the risk penalty, and vice versa. So this is 280, this is 70. Okay, so 280 upon 70, and therefore my risk penalty is 4%. That means I am ready to take higher risk. Okay, I am ready to take higher risk for earning higher returns. But because I am ready to take higher risk, my tolerance level is higher, and therefore final answer, utility is equal to my expected returns minus the risk penalty. So expected returns are 15, My penalty is 4. So 15 minus 4. Final answer is 11%. Okay, so expected returns are 15 minus risk penalty is 4. So what is my level of utility? 11% after considering the risk angles. So if you know the formula, it's a matter of 1 to 2 minutes and it is done. So that is question number 3. Now question number 4. The moment I see such words, question 4, Z and 0 to Z, it immediately I know it is based on normal distribution. Area under the bell curve, inverted bell curve. Okay, so company has a mean value. So mean value is the average, what we call as X bar. The management wants to determine the probability of the NPV under different ranges. Another hint, the moment word is ranges, that means we are talking of normal distribution. The standard deviation of the project is 6,000. What will be the probability of NPV between 7,200 to 13,200? Okay, so first things first, what is the formula? The formula is the range minus average, that is mean, upon the standard deviation. So this is the first thing you need to keep in mind. The first thing you jot down is the formula. So this formula we are going to use. And now they are given what is the range? 7,200 and 13,200. So in the first case, what we do? We do 7,200 minus the mean. So mean is 11,700. Okay, let's do here. So there are two things. One is Z1. So same formula, 7,200 minus 11,700 upon 6,000. So this is first minus 0.75. So 7,200 minus 11,700 divided by 6,000. So we get the first answer. Okay, we get the first answer. Minus 0.75. Now second range. So second range they have given is 13,200 minus average 11,700 upon standard deviation is 6,000. So 13,200 minus 11,700 divided by 6,000. It is on the positive side, that is plus 0.25. So we have two values of ranges. One is this, other is this. And now they have given the data. Okay, so 0.25, so we have to take this, and 0.75 we have to take this one and simply add them. That is the final answer. Okay, so Z1 was the negative part, so 0.75, so we pick up 0.2734, and Z2 was 0.25, 0.0987, simple addition. So 0.2734 plus 0.0987, so 37, that is 0.3721. If you multiply by 100, we get the answer 37.21%. So 37.21, yes, option 3 is our final answer. So normal distribution, range will be given, simple formula, range minus deviation, range minus mean upon deviation. So you apply for 2, Z1, Z2, find the values 0.25, 0.75, answer done. If you know the formula, matter of 2 to 3 minutes, not more than that. Okay, let us go to the next question, question number 5. On 1st August, okay, Miss Rudra, on 1st August 2023 had an initial offer of AB mutual funds. So initial offer, we call it NFO, new fund offer, invested 10,000 units at a face value. Offer price was 10 rupees. On 31st March 2024, dividend was declared and given by the mutual fund, which is 10%. Miss Rudra found her annual yield, okay, her annualized yield, her ROI was 150%. what will be the value at the end of the year. So NAV is the value of the fund of the units at the end of the year. That is the question asked. Okay. So 150% is annualized. So annualized is 12 months. But whether she has invested for 12 months, that is the question. See here, she invested on 1st August and they are asking us 31st March. Okay, so it is not a period of 12 months. This is the important point. The investment is on 1st August. So April, May, June, July, 4 months are gone. So investors started in August and August till March. So we are talking of only 8 months. So this is the key in this question. So what they have given is 150%. 150% is per annum, annualized. Okay. So what will be for 8 months ROI? Because here we have to find out absolute returns. So absolute return means for the actual duration. And actual duration is not 1 year. Actual duration is August to March, which is 8 months. So if 150% is for the year, okay, so what we do simply 150 divided by 12 into 8 months, and therefore the ROI for 8 months comes to 100%. So what I did 150, this is for 12 months, so what will be for 8 months? Simple cross multiplication. And therefore my ROI, absolute returns on this fund, is 100%. Then I use the formula of holding period returns, HPR. Okay, we use the concept of HPR, that is holding period returns. HPR, holding period returns, formula is simple. NPV1, that is end of the year, minus NPV0, start of the year, plus any dividend received upon NPV0, that is start of the year. This is the formula. Now holding period returns, holding was only 8 months. So in 8 months, what are the returns? 100%. What is NPV at the end? We don't know. So I'll assume as X. What was the starting point? 10 rupees. It is given invested at 10 rupees. Plus dividend. So dividend was 10%. So 10% of 10 rupees. So dividend is rupee 1. Upon original price is 10. So if you solve the equation, 10 into 100% is 10. Then this one will go on this side, that is 9. This will go on this side plus 10. So solving the equation, our answer is 19 rupees. So what will be the NAV at the end of the period, that is as on 31st March? The answer is 19%. So the important point, most important point is this annualized return. So annualized is per annum, but actual duration is 8 months. So students, please read the question carefully. The duration, what month it is invested. Okay, so be careful. Otherwise the question was easy. Now next is a theory question. Okay, direct question. And we are already seen theory question. The best part is if you know the answer, 1 mark. If you 1 minute. If you don't know the answer, still 1 minute. So do not waste time. Which of the following digital financial technologies or technological concept is a type of distributed ledger? So this is the keyword, distributed ledger, which provides an order time-stamped, highly secured record of transactions. So when we were reading this chapter, I'm sure you must have underlined this word, distributed ledger, when it came to the concept. And which concept uses the distributed ledger? The answer is blockchain. So the blockchain technology uses a type of distributed ledger system. So if you remember, that's it. That's it, simple. If you don't remember, then it's simply a guess. It's simply a guess. But obviously we have to guess, nothing negative about it. So let's guess, but here the correct answer is blockchain. Next question, portfolio manager has a portfolio whose current market value is 1,800 lakh. It is expected that the market is likely to correct going down and hedging is needed. Index futures are presently at 8,000 and 200 are the lot size. He wants to hedge 100%. If the number of index contracts is 180, what is the portfolio beta? Okay, what is the portfolio beta? Okay, so formula simple again, number of contract is equal to portfolio into beta, and 100% yes into 100% upon present price is 8,000. Okay, index futures is 8,000 into lot size, that is 200. Lot size is 200. So put the values. Portfolio is 1,800 lakh. Beta we have to find out. 100% hedging is needed upon 8,000 into lot size is 200, and number of contracts are already given 180. Number of contracts are given. So 1,800 is in lakhs. Okay, you have to adjust that figure. Divided by 1,800 lakh. So the answer comes to 1.60. Okay, solving the equation, the value of beta. Okay, solving the equation, the value of beta comes to 1.60. That is option A. Same, it's an easy formula. Such questions have been asked earlier as well. Hedge ratio, how many contracts to be taken. So same type of question. Just that in the earlier papers they had asked how many contracts to be taken. Here they have given the number of contracts and they are telling you find beta. So formula same, just substitute the values, you get the missing figure. Next question. The current price of stock is 1515. Expected that the price will either go up to 1,818 or 1,212. So two options. That means this is binomial model. If the strike price is 1515 and risk free, that is RF is 7%, what is the probability of decrease? Okay, they are asking the probability of decrease. So we know there is a formula of probability of increase. So we first find out increase and then next is decrease. So what is the formula? Probability of increase is equal to spot price into 1 plus RF minus lower price upon higher price minus lower price. So what is the spot price? 1515 into 1.07, that is this, minus lower price 1212 upon higher price 1818 minus 1212. So let us solve the equation. 1515 into 1.07 RF minus 1212 divided by the difference. Okay, so 1818 minus 1212, that is 606. So the answer comes to 0.675. This is the probability of increase. And they have asked us probability of decrease. A simple calculation, if increase is 0.675, so decrease will be 1 minus 0.675. 0.675. So correct answer is 0.325. That's it. Again, matter of 2 to 3 minutes. So if increase is 67.5, then decrease will be 1 minus, that is 0.325. That is the answer. Question number 9. If the conclusion and opinions of equity analysts and other experts based on publicly available information. So this is based on theory of efficient market hypothesis. What does the theory say? Theory says there are three parts. One is weak form, one is semi-strong, and one is strong. So what does weak form have? Weak form has past information. What does semi-strong has? It has public information. What does strong form say? It says secret information. So that is how the theory is designed. And what does the question use the word? Publicly available information. So available with the public today. So automatically the answer is semi-strong form of efficiency. And semi-strong form of efficiency is option B. So again, if you know the theory, it's a matter of 1 minute, you get the answer. Next question, also based on concept. Which of the following Greek with respect to option measures the sensitivity with respect to time to expiry? Okay. So now just a quick revision again of the alphabets. So one is we have is delta. So what does delta tell you? Delta tells you the relation between premium and underlying asset. What is the price movement between them? Okay. Then there is rho, which tells us the relationship of premium and interest rates. So rho talks about interest rates. Then they have given vega. So vega is talking about the premium, okay, and the volatility in the underlying asset. And they have given theta, which is related to time value. As time passes, time to expiry, the price of the option is affected. The question here is time to expiry. And what is time to expiry? Answer is B, that is theta. So obviously we know the answer. I would have simply ticked theta and went ahead. But since we are talking of Greeks, just a quick revision, simple. So we are doing the MCQs not for the sake of doing MCQs. We are doing the MCQs along with understanding why. So I know option B is correct, but my job is, my responsibility is to also tell you why the others are different, why they are not the right answers. And while doing that, we have simply revised the concept of Greeks. I hope all these is now not Greek and Latin to you. Okay. Chali, jokes apart, let us go ahead. Question number 11. So question 11 is on Forex. Company is an export customer who is relied on the interbank rate of dollar to rupees, requested to banker to purchase. So see the wording, banker to purchase. So banker is going to buy. Okay, so banker is going to buy because exporter, okay, what is the rate quoted if the banker wants a margin of 0.2%? So we have to use the bid rate, number one, and banker is going to purchase, and the common sense rule of business is you purchase at a lower rate, and therefore what is the spot rate given? Spot rate is $1 is equal to rupees 82.45. Now since we are talking of bid, since we are talking of margins, so whenever it's a bid rate, the margin will be subtracted. If it was ask rate, we would have added the margins. and therefore what is the rate quoted by the bank? On the calculator, 82.45 minus 0.2%, and they said up to 2 decimal points, so 82.285, that is 82.29. So answer is option C. If the question would have, instead of the word exporter, if the question would be importer, then ask rate. Because it is exporter, it is bid rate. And bid rate is buying rate. Profit कब होगा? When buying rate is less. So margin minus from bid rate. Direct quote. If it was ask rate, then margin will be added to the ask rate direct quote because you sell at a higher price. So ask rate margin will be added direct quote, and in case of bid rate margin will be subtracted. That's how it works. Simple. The next one again, it's a concept question, theory question. Which of the following statements true? For characteristic line, y-axis represents the returns and x-axis represents the returns for the market index. So one is security and one is index. Then second statement said SML line is the same as the characteristics line. Obviously the answer is no. So one thing I know, that SML line is not the same. So this statement is not correct. Then the slope of the SML line is the beta. Again no, because the slope of the SML line is risk premium. This is the slope, and therefore third is also wrong. Second is also wrong. Theory of elimination. So first two are gone. That means the first one is correct. Because see, they don't have an option that all three are wrong. Okay, if the option was all three are wrong, then obviously I have to think again. But only two is right. Obviously two is wrong. Only three is right. No, three is wrong. 1 and 2 are right. No, because 2 is wrong. So correct answer is option A. Only 1 is true. Okay, so here we have to identify, okay, that I don't know whether this is right or wrong, but the second one is definitely wrong. The third one is definitely wrong. And then when I saw the options, then first one has to be right. So sometimes it's little bit of common sense, little bit of small tricks to get the answers. Okay. Then next question, again a theory question. Even next two are theory. Okay, good for us. It saves time. The concept of securitization. Now we know securitization. Okay, banks do that. We issue instruments. And which instruments we issue? We issue debt instruments. That is the question related here. So it is related to debt market. It is very specific. Somebody might say, sir, that even capital market should be right answer. I agree, but capital market has equity also. But securitization is not about equity, it's always debt. Then somebody might say, sir, but why not option B? Money market is also debt. But money market is short term. Securitization is a long term concept. And that is why the correct answer is C, debt market. So why not this? Because it contains equity. That's why it is cancelled. Why not this? Because this is short term. And securitization is a long term concept. That's why this is cancelled. And why not this? Because it is considering forex. Securitization is within the country and it's about the asset backed securities and so on. So it is different from your foreign exchange market. And therefore the right answer is C, debt market. Next question, number 14. Which of the following is a part of, component of digital finance ecosystem framework? Let us see what is a part of ecosystem. Digital money, yes. Assets, yes. Liabilities, digital liabilities, no. So 1 and 2 are correct, which is option D. A and B both are correct, because digital liabilities as such is not a part. So digital money, yes. Okay, remaining two definitely yes. Chale, last question, number 15. An investor buys a call option with a premium of rupees 150. Exercise price 45. Okay, premium is 150. Exercise price is 45. Current market price is 42. If the share price after 3 months reaches 50, what is the profit made by the option holder? Okay, simple. 100 shares is slot size. Okay, so what is the price? So actual price at expiry. So actual price is rupees 50. What is the exercise price? Exercise price is rupees 45. What kind of option we are talking of? Okay, what kind of option we are talking of? We are talking of call option buyer. Buy is a call option. So we are talking of call buyer. And call buyer kaun hai? Who is a call buyer? He is bullish. He wants the actual price to go up. And whether actual price is more than exercise price, the answer is yes. So what he will do? He will exercise the option. And once he exercises the option, he will have a gain. 50 minus 45, gain is 5 rupees. But 5 rupees is each, multiplied by lot size. Lot size is 100. Therefore, total gain is 500. But you have already paid a premium. So from this, minus total premium paid, that is 150 given. And therefore, your net amount, net payoff is 350 rupees. So do we have 350 as an answer? The answer is yes. Option B is the right answer. So this is a very basic sum on options. That means even if the high level derivatives, high level option contracts, you may have not studied well, but at least do one thing, the basic concepts you must do well. This is one of the basic questions, that call option, the price goes up, we will exercise. If the price would have been less than 45, we would have cancelled, let it lapse. Then my maximum loss would be premium. Maximum gain can be anything for a call option holder, any holder, whether it's a call or a put option holder. The maximum loss for an option holder is premium. The maximum gain for an option holder is unlimited. If you were an option writer, opposite side, your maximum gain would have been premium and your maximum loss would have been anything, unlimited. Okay, so that is how it works. That is the end of the next paper, that is June of 24. So now we go ahead to December of 24. Let's see. Let's go to the next paper, that is December of 2024. Now let us see what kind of MCQs were asked. Okay, whether they were tough ones, whether they were easier ones. So let us solve one by one to have an idea. First question. The company has invested 36 crores in the recent project. The company expects a uniform cash flows of 12 crores. These are inflows for 5 years. The cost of capital of the company is 12%. Okay. The modified NPV of the project is 8.123 crores. Now, a new concept has come up, that is modified NPV. Okay. So let us see what this modified NPV is all about. So basically, modified NPV talks about your normal NPV, okay, as well as it also talks about the terminal value concept. Now, what is the concept of terminal value? It is the value of the project after the end of your estimated life. So if your project goes on for a very long period, but our estimates can be maybe for 3 years, maybe for 5 years, but thereafter also the project is giving returns. So that estimation is called as a terminal value concept. So that is what we use here. So what they are asking is, what will be the reinvestment rate applicable to the cash inflows expected to be generated by the project? Okay. So you are given the present value factors as well as the future value factors. And what we want to find out, or what they are asking, is the rate. What will be the rate considering modified NPV if, see now what happens is, IRR has a deficiency, IRR method. So IRR says that the future cash flows, okay, the money is reinvested at the IRR rate, which is not practical. And that's why the modified NPV concept came into the picture, which says that the cash flows are reinvested in the rate of cost of capital. So considering the given information, they want us to find out that reinvestment rate. So let us find out how it is done. Now just for practice, what we'll do is, we'll just first find out the normal NPV. So for normal NPV, okay, normal NPV is present value of inflows minus your investments. So what is the present value of inflow? Present value is, inflows are 12 crores and right now the rate is 12%. Okay, right now the rate is 12%, and therefore if you consider 12% and our normal PVIFA, so if you consider 12%, okay, 1.12, 12%. So 12%, so that is 12 crores here, and 12% 5 years, it is not given, but we have calculated on the calculator 3.60. This we know how we do that. 47 using either GT function or otherwise memory function, minus investment, that is 36 crores. So into 12 minus 36. So your normal NPV is rupees 7.26 crores. This is your normal NPV. Okay, just for the sake of practice, simple. The question is asking about modified, so we'll come to that, but just for the sake of practice, we have first calculated the normal NPV. And the normal NPV considering 12%, okay, normal NPV considering 12% is 7.26 crores. And the modified NPV is already given 8.123 crores using a fresh reinvestment rate, and that rate we have to find out. Okay, chali. So now let us use the modified NPV thing. Okay, so modified NPV is equal to present value of terminal value, present value of terminal value minus investment, present value of terminal value minus investment. And now this amount is given 8.123. Okay, and we have not been given, so we just know that terminal values will go on. Okay, so 12 crores is the cash inflows which will continue afterwards, multiplied by FV, future value. They have given this future value for different rates. We have to find out the correct rate. This multiplied by the present value factor PVIF minus investment. Now this calculation happens at the end of the normal life, and normal life is 5 years. Normal life is 5 years. Okay, so let us see here. And investment is available. So what is the investment amount? Investment is 36. So this 36 will come on the other side. So 36 plus 8.123, that is 44.123 is equal to 12 into future value and present value. This will be for the last year of projection. So last year of projection is 5th year. So 5th year value is given in the question, 0.5674. And now we have to solve this equation. This divided by 12 divided by 0.5674. Okay, and therefore it comes to FVIFA. What they have given, FVIFA, the R percentage, this we have to find out, and 5 years is the duration. Solving the above equation, it comes to 6.48. Now we find in the table where is 6.480. Okay, we find in the table for the value of R where is 6.48, so that is here 6.480 future value. And what is the rate here? Rate is 13%. So what is the reinvestment rate for terminal value? So final answer is option A, 13%. So in the last so many papers we are solving, okay, this is nearly the 7th paper we are solving, and this modified NPV has been asked just once in all the 7 papers which we solved. Okay, they had asked adjusted NPV 3-4 times. Okay, but first time they had asked the concept of modified NPV. Okay, let us go ahead. Next question. See, so one question at least they will be asking which will be little bit on the tougher side. Correct? उतना तो बनता है. ठीक है. Question number 2. Now what does question 2 tell us? Let us see what is question 2 telling us. A company is expected to grow at 8% per annum, that is growth rate, which is currently paying rupees 10 as a dividend. For investment at a risk level, investor requires 15% return. What is the value of the stock? So this is K, which is given to us. Okay, K is given to us. Currently paid. So this is DPS 0. So DPS 0 is given 10. What is the value of the stock? Simple dividend formula. So market price is equal to DPS 1 upon K minus G. Okay, upon K minus G. So last year it was 10 with a growth rate of 8%, and therefore next year it will be 10.80 upon K, which is 15% minus 8%, and therefore 10.80 upon 7%. So answer 154.29. So answer is 154.285. So round off 2 decimal places. So correct answer 154.29. So first question was on the tougher side because it is something different, not asked earlier. So second question they have compensated by asking a easier one. So in the examination, what you should do, the moment you see modified NPV and if you are not confident about it, you don't remember the formula, you don't remember the concept, okay, so don't waste time on it. Just take a hint, just take a click, just put a, you can say a fluke, tick something and go ahead. So don't waste time in doing that, because the second one, the easier one, is waiting for you. Okay, that is question number 2. Now question number 3 is on Forex. The spot and 6-month forward rates of pound in relation to rupee are given. 77.9542 and 78.1255. Okay, so this is the bid rate and this is the ask rate, and this is the forward rate. Again, this is the bid rate, this is the ask rate. It is a direct quote, and direct quote, the bid rate is lower, the ask rate is higher, and therefore I have identified. So 77 is the bid lower and 78 point something is the higher. So ask rate. What will be the annualized forward margins? So they want the margin premium, that is with respect to ask price. So they are telling us do the calculation using the ask prices, the ask rates. Again, a very easy question. They just want us to find out the premium percentage. That's it. So what is the first? I'll write down the ask. Okay, just for surety. So spot rates are given. 1 pound, sorry. So 1 pound is equal to rupees 78.1255. I am writing only the ask rates. And forward rate, 1 pound is equal to rupees 78.9650. Okay, and now the formula. Okay, the formula is very simple. It is a direct quote, and therefore forward rate minus spot rate upon spot rate into 100 into duration. Now what is the duration here? Duration is 6 months. So into 12 upon n. N means 6. Okay. So substitute the values. So forward rate is 78.9650 minus 78.1255 into 100 into 12 upon 6. Okay. So you get the answer. Okay, so forward rate, I'll repeat, 78.9650 minus 78.1255 divided by 78.1255. And final answer is 2.15%. Final answer 2.15%. This is called as the forward premiums. If the answer was negative, it would have been called as a discount. So we would have said that pound is at a discount in the future if the answer would have been negative. But here the answer is plus, positive 2.149, say 15. So positive answer, it means it is at a premium. That is question number 3. Again, an easy question. You just have to know the formula. Question number 4. A portfolio managers realized an average annual return of 15%. The beta is 1.2, standard deviation 25. Okay, so returns of market, average returns of market index is 11, standard deviation of market is 20, and risk-free return is 4, RF. The Sharpe ratio will be. Okay, so they have given so much of information, but most of that information is not needed. So this is called as an information overload. Okay, so two ways the institute tries to fool us. One is by giving very less information and then we are stuck what to do, what not to do. And then in this question, they have given us a lot more information again to confuse us that okay, whether I should use this or ignore this. But focus on what they want Sharpe ratio. And therefore, first write the formula of Sharpe ratio. So automatically you know what information is needed and what information is not needed. So Sharpe ratio is RP, that is returns of the portfolio, minus RF. So whether returns of portfolio are given, yes, 15%. So RP is 15 minus risk free is given, yes, that is 4 upon standard deviation of the portfolio. So where is standard deviation of the portfolio? Standard deviation of portfolio is here, that is 25. So 11 upon 25, that is the answer. That's it. A lot of extra information given. So Sharpe ratio is 0.44. Finished. 2 minutes, 2 marks. Okay, done. Easy. So the first one was little tough, but 2, 3, 4 all are easy. Full marks in 2, 3, 4. Now question number 5. Dash is the study and analysis of security price movements, prices up and down, chart pattern, trends up and down. Question is price movements. Okay, on the following assumptions, there is a basic trend upward or downward. The trend is repetitive, history will repeat itself. That means couple of years back whatever pattern was there, the same pattern is today. History is repeating itself. Shares have little relationship with intrinsic value. That means shares are not connected directly or very small connection with the balance sheet P&L, and it is more on psychology. So all these are features of technical analysis. So the moment you use the word price movements, price action, trend analysis, repetition, okay, the pattern is repeating itself, these are all nothing but technical analysis. If the question would have been about balance sheet, P&L, then we would have used the word fundamental, company. Or if the question would have been GDP growth rate, if the question would have been FDI, then again fundamental, economic analysis. But they have not used any of these words. They are simply saying patterns, trend, price movement, technical. Now, there is another way of finding the answer. If you see here, option A is fundamental. Okay, option C and D, they are also parts of fundamental, because fundamental follows the top-down approach. You study the economy, you study the industry, you study the company. All three are part of fundamental. So what is the who is the odd man out? Odd man out is option B. So that is another way of finding the answer. So one is the moment you see the question, आपके दिमाग में आएगा technical. If that doesn't happen, then you read the options and then you realize that A, C, D are the same thing. So who is the odd man out? The odd man out is option B, that is technical. Next question, again a theory question. Which one of the following digital assets is a cryptocurrency? Okay, which is pegged. Pegged means which is linked to any reserve asset like a fiat currency, commodity or others. Okay, so which cryptocurrency is pegged, connected, linked to reserve assets? So option B, email. So obviously that is out of questions. Option B is no. Then when you use the word private, so private automatically means it is not linked to anything else. And question says it is linked. So the word private means it is not connected, it is not pegged. So option C is gone. So option B is gone, option C is gone. So what remains? Option A, NFT, non-fungible token, and D. But now when you talk of non-fungible token, this is also gone because has its unique features. Okay, non-fungible has unique features and therefore it is not linked to something else, and therefore these three are not the answer. The correct answer is option D, stable coin. So again, two ways of doing it. Either if you know stable coin features, then the moment you use the word pegged against reserve assets, ting, stable coin. But if you are not sure, then you read the other options and then you eliminate them. So what remains is stable coin. Okay, that is the answer. Next question. In June, a 6-month call on REIT stock with an exercise price of 25 and the premium is 5 rupees. The spot price was 20. Risk-free rate was 5% per annum. How much would you willing to pay for a put option with the same maturity and same exercise price? So what all data given? 6-month call option. So they have given the date of call. They have given current price. They have given RF. And they are asking put option. So in the same question, they are asking call option. They are asking or they're mentioning put option. They are mentioning RF. Okay. As well as they are mentioning the current price. So when all these things are together, that means we know that they are talking of put call parity. In the option concept, there is a concept of option pricing. Okay, one was binomial. Okay, then there is Black and Scholes, and one of the other thing is put call parity. So let us see what put call. Again, it's a straight formula. Okay, if you know the formula, so let me write the formula, that is C plus present value of X is equal to put option plus S. So what this means, C is the call option premium plus present value of strike price is equal to the put option premium plus S is the spot price. S is the spot price. So if you know the formula, just substitute the values and you get the answer. So what is the call premium? The call premium is 5 rupees. So 5. Then present value of the strike price. Strike price is exercise price, that is 25. So 25 into, they have given the present value factor 0.9756 is equal to put premium. This is the missing figure, plus spot rate. Stock was 20 rupees. So this is also given, that is 20. So solving the equation. Okay, solving the equation. 25 into 0.9756 plus 5 minus 20. So the the put option answer should be 9.39. So correct answer is 9.39. So this is, see how to identify, or rather how did I identify? Because in the same question they are giving call option premium, exercise price, spot price, and they are asking put option premium, and they have given RF. All these are constituents of the put call parity. That is question number 7. Now question number 8, a theory question. Which of the following is not a benefit of digital currencies? Not a benefit. Keeping track of transactions. Okay. Technological efficiency in storing and transacting reduce cost. Scope committing illegal activities. Okay. Provide digital record. Yes. So considering the options, keeping track of transactions, yes, it's a benefit. Technology efficiency, it's a benefit. Providing digital record, it's a benefit. And therefore committing illegal, such as money laundering, tax evasion, on this is the odd man out. So which is not a potential benefit. So answer is illegal activities. That is question number 8. Question 9 also is a theory concept based question. Which of the following statement is true with respect to risk penalty? So the concept of risk penalty we have learned in the earlier paper as well. There I explained in detail that risk penalty is based on, okay, the variance and the level of tolerance. So tolerance is an investor's personal level. That means if I am ready to take more risk, okay, that means I also expect a higher returns. So ज्यादा रिटर्न्स के लिए मैं ज्यादा रिस्क लेने को रेडी हूं. दैट इज माय डिग्री ऑफ टॉलरेंस. एंड जितना मेरा टॉलरेंस इज हायर, दैट मच माय रिस्क पेनल्टी इज लोअर. That is the whole idea. Now let us see what the options are. First option, they are saying higher the risk penalty, lower the utility of return. Yes, this is correct. This is correct. Higher the penalty, lower the utility. Utility means your net returns after risk returns. That means without the risk penalty, I wanted 20% and there is a penalty of 5. So what will happen? My utility will be expectation 20 minus penalty 5, 15. So higher the penalty, lower the utility. Yes. So first option is valid. That means the statement is true. We want to find out what is true. So first is true. The risk penalty will be lower for smaller values of risk tolerance and higher values, risk penalty lower for lower. No, no, no. Risk penalty has inverse relation with tolerance. And here they are saying risk is low for tolerance is low. So this sentence is wrong. They are inverse. This sentence says they are directly related. So two number, that is second sentence is false. Third, for risk loving investors, the risk tolerance is high. Correct. And therefore risk penalty is low. See, tolerance high, penalty low. Inverse, correct. So this statement is also true. That means 1 and 3 are true. So any option which says 1 and 3 are true. Okay, that is option D. So correct answer is option D, which says 1 and 3 are true. So again we understood the concept of risk penalty, utility and so on. Tolerance. Next question, based on Greeks, options theoretical value increases if the interest rate decreases. So interest rate, theoretical value, we are talking of rho. In the last paper we discussed in detail what is delta, okay, what is theta, what is gamma, what is rho, what is vega. And in earlier papers we also discussed that this is increasing and this is decreasing, inverse relation. So when it is inverse relation, it is a row of a put option. If interest rate rises, call option will rise, direct relation. If interest rate rises, put option will fall, inverse relation. So here they are talking of value increase, interest rate decrease, inverse. So answer is row of put option. Next question. A portfolio manager having a portfolio beta of 1.8, current market value 1,500 lakh, the market will fall, so hedging is needed. Currently index future is at 9,000 and lot size is 200. So typical question asked again and again. Hedge ratio, number of contracts. So how many contracts are to be taken? So number of contract, this we are solving maybe in the last 7 papers we are solving this for at least 4th or 5th time, I guess. So number of contracts is equal to, now I am putting directly 1500 into beta 1.8 into 100% hedging. Okay, into 100% hedging upon what is the Nifty price 9,000. How many lots? 200. So 1500 into 1.8 divided by 1500 lakhs. So answer will be 150 contracts. See, whatever this is 1500 lakh. So the final answer what you get, you multiply that by 1 lakh. Okay, so therefore once we do that, then we get the answer of 150. Okay, 1500 is in lakhs, rest all are as it is, and therefore whatever the final answer came, I multiplied that final answer by 1 lakh, so you get the correct answer 150 lots, 150 contracts to be precise. Okay, now next question is based on mutual funds, NAV. Okay, mutual funds NAV is the next question. Consider the following parameters of JMB mutual fund. Okay, so we know the formula of NAV. You add all the assets, you subtract the liabilities, divided by number of units. And they want to purchase, so they have asked what should be the purchase price, and therefore they have given entry load also. So in the end, we have to also adjust the entry load. So let's see what all to be added. So value of investments plus receivables plus accrued income plus other current assets plus liabilities minus accrued expenses minus. So you add the 4. Okay, So 4169, 325, 95, 962 minus liabilities 225. All these things will be subtracted. Okay, all these things will be subtracted. So approximately the NAV plus minus, so numerator will be 4350 after plus minus divided by number of units. So number of units are 300 divided by 300. So NAV comes to 14.50. Remember, this is NAV. This is not the final answer. See, Institute is smart. They have given here 14.5. Option C they have given because they know students in a hurry, in a rush, they will click 14.5 and go ahead. But the question is, what is the purchase price? And therefore, we have to adjust the entry load. So purchase price is equal to, you know the formula, just that in the examination, remember it. So NAV minus, sorry, upon 1 minus entry load. So NAV is 14.50 upon 1 minus 3%. So 1 minus 3%, that is 0.97. So 14.5 divided by 0.97. So final answer 14.95. Okay, so answer was in front of you, but we were in such an excitement, such a hurry that the moment we got 14.5, we take 14.5, but that is NAV. Question did not say find NAV. Question said find purchase price. That is the answer. If it was exit load, then the formula would have been NAV upon 1 plus exit load. But they are asking purchase price, so entry load is given. Then question number 13. So if you remember, question 1 was tougher, and from 1 onwards, all of them were easy. Okay, all of them were comfortable. So we are on question 13. So out of the 12, just 1 was odd. Remaining 11 were comfortable. So you have to focus on the positives. Focus on what is the good part. So out of 15, see, 1 or 2 or 3 or 4 are bound to be slightly on the tougher side. So but don't bother. Focus on the remaining 10-11 questions and score 20-22 marks in the MCQ section. Okay. Next question. So Sharpe ratio and trainer ratio are given 0.37 and 4.16. Risk premium, that is RP minus RF, directly given 6. Standard deviation is given. Standard deviation of market is given. And correlation, we have to find out R, correlation coefficient between the portfolio and the market. This is what we have to find out. Okay. Okay, chali. So let us write the formulae and then we'll try to see how to go about it. So Sharpe ratio RP portfolio upon RF upon standard deviation. Trainer ratio RP minus RF upon beta. Okay. And these ratios are given. Okay, these ratios are given, that is, this is 0.37. Okay, 0.37 is equal to RP minus RF upon standard deviation of portfolio, and trainer ratio is given 4.16 is equal to RP minus RF upon beta of the portfolio. And now if you observe, they have what all they have given. Okay, they have given this is 6. Okay, this is 6. Okay, So with this, okay, and what they have asked us, they want to find us, they want us to find R, that is correlation coefficient. Okay, they want us to find out R. Okay, shall we? So whether this approach will take us to the right answer or we have to change our approach, let us check. And have they given beta value? Risk premium is 6. Okay, standard deviation of funds is 11.8. Okay, okay, we have to use something else. Shall we? Let us use a different approach. Okay, let us use a different approach. So if I do uh, Sharpe ratio upon trainer ratio. Okay, Sharpe ratio upon trainer ratio. So RP minus RF, these are the common points, so they will be cancelling each other, and then we'll remain with this kind of a thing. And Sharpe ratio is 0.37 upon trainer is 4.16 is equal to this. Okay, what next? So beta will be is what next to be done. Okay, so if you see the equation, it will be Sharpe upon trainer. Earlier I had written the opposite, but it is beta upon standard deviation of portfolio, and standard deviation of portfolio is given in the question. Okay, standard deviation of the funds return is 11.8. This is given, so 11.80. So therefore we will get the value of beta. So beta will be 11.8 into 0.37 divided by 4.16. So beta comes to 1.05. Beta value comes to 1.05, and now beta is equal to standard deviation of portfolio upon standard deviation of market into R. So beta is 1.05, standard deviation of portfolio is given, and standard deviation of the market is also given. Market is 9.56. So 11.8 upon 9.56 into R. So solving the equation, 1.05 into 9.56 divided by 11.80. The final answer is 0.85. This is the value of R. So slightly different way, different approach. Okay. So final answer is option B, 0.85. So I'll repeat what we did here. Okay. So we did here is Sharpe ratio upon trainer ratio. Now RP minus RF is common, so that will cancel itself. And then what remains is this. This will remain. Beta of portfolio. So this is a new equation which is created. So this you can use it. And this is given 11.8 is standard deviation of portfolio given. So we found beta and all the other information given. So now this new thing you can keep in mind. So whenever any question comes, we can have this approach of solving. So this was kind of difficult. Again, out of 13, 2 are difficult, 11 are easy. Next question. In 100 days stochastic analysis, again for the first time stochastic has come. Earlier we had seen RSI. So stochastic is also a type of technical analysis indicator to identify whether the stock is overvalued or undervalued. So in the 100-day stochastic analysis, if the closing price is 160.5 and the 100 days low and high price, so range is given, so then stochastic K will be equal to, okay, so direct formula, K is equal to closing price minus low price upon high price minus low price. So direct formula, keep in mind. So closing price 160.5 minus low price 145.2, high price 190 minus 145.2, and finally into 100. So 190 minus 145.2 and 160.5 minus 145.2. So 34.15. Okay, so it is a direct question, direct formula based question. So some questions are theoretical, concept based. Some questions are formula, but we have to go here and there, one formula, second formula, and third is direct formula, get the answer. Okay, so answer is this. So basically stochastic analysis, as I told you, it is a tool of technical indications. There is a range which is given. Okay, there is a range which is given, and the range is say 0 to 100. So if it is 70 and above, if it is 75 and above, we say that the stock is, we use the word overbought. So overbought means it is overvalued. It is too costly to buy. Don't buy now, basically. So overbought is overvalued, and the other word is oversold. Even lower side, if it is 30, 35 numbers, then it is oversold, means it is undervalued. So you may think of buying it. So like RSI also has the same range. RSI is around 30 to 70. So anything above 70 in RSI, it's a overbought. Anything below 30, it is a oversold. And then we identify the trend. If it is going from 30 towards 70, that means the valuations are looking good. You can enter the market. If it is coming down from 70 to 30 or below that, it means it is going downwards. It is a bearish market. So don't buy right now. It is going to fall. So these are just indicators in the technical field. That was question 14. Now question 15, last one of this paper. An event study is a test of which form of efficient market hypothesis? Event study. So event study means an event has occurred. So event here means public information. So event has occurred, that means it is a public information, and public information means semi-strong form. This also we discussed in the earlier paper. If it is past old information, then weak. It is present event based public information, then semi-strong, and it is secret, undisclosed, unpublished information, then it goes into strong form. So event based is public, so weak form no, semi-strong yes. So correct answer is option B. Only semi-strong form of efficiency. So that is the end of this paper, that is December of 2024. Okay, the next paper is now the June 2025. So we started our journey from 2022, old pattern, then 23 old and new, again December 23 old and new, then 24, and now we are reached June 25. Okay, chaliye, let us start. First question. Yes, so what the question is saying, company is thinking of an investment project for 5 years with an initial investment of 30 crores. The company expects cash inflows, regular inflows every year of 10 crores for 5 years. The expected rate at which the said cash flows will be reinvested is directly given, 12%. The normal cost of capital is 12. What will be the modified NPV. Now this has come back to back twice. In the last paper also it was there, and in that paper the modified NPV was given and we had to find the reinvestment rate, and this is easier because we have to simply find the modified NPV. So what is the formula of modified NPV? So modified NPV is equal to present value of terminal value minus investment. This is the formula. And now to find terminal value, okay, they are given that uniform cash flows of 10 crores. So 10 crores will continue even after 5 years. Okay. So modified net present value is equal to, now 10 crores, yes, into the reinvestment rate is 12%. So we have to take 12% for 5 years. So FVIFA 12% 5 years. Okay, first of all this multiplied by the present value PVIF. But remember, PVIF is not of 12%, PVIF is of 10%, because after 5th year, normally the rate or original rate is 10. So common mistake that future value rate is going to be 12 because that is the reinvestment rate, but present value rate will be 10% and 5th year. So PVIF 10% and 5th year. So this minus the investment. So 10 multiplied by 6.3528 multiplied by 0.6209. These are the present value of inflows, and minus investment is 30. So 10 multiplied by 6.3528 multiplied by 0.6209, and whatever the answer is, minus 30. So final 9.445. So 9.445, correct answer option A. So important thing in modified NPV is that terminal value you take the rate of future FV, sorry. But when it is discounted, okay, so this rate, many times students, they take the same rate 12 and 12. The answer is no. The reinvestment is for terminal value. The present value is as per the original rate. So this is the important keyword in this question. So final answer 9.445, option A. Okay, let us go ahead. Second question. Company share is traded presently at 80. It is expected that a future dividend of 4, and after 1 year it will grow for 8%. What is the expected return? So it cannot be easier than this. So what they want is KE formula. KE is equal to, yes, this formula was there in the intermediate paper also. It's an intermediate question asked in the final exam. So DPS1 they have already given. Okay, so KE, current market price, sorry, current market price, yes. So this is the original formula. Market price is this, and from this formula what is the expected returns, and therefore KE is equal to, what is DPS1 is currently traded at 8. Our market price is 80, DPS1 is 4. So 4 upon 80 into 100 plus G is 8. So 4 upon 80 plus 8. So final answer 13. Option B. Simple. So first one, modified NPV. Since we had done it in the earlier exam also, so now we were a little bit aware of it. And this one is straightforward, no tension. All the figures given except one. Put the formula, get the answer. Easy. Next question. A portfolio manager realized annual return of 15%. Okay, so this is returns of portfolio. So this is RP. The beta of the portfolio is 1.2. Standard deviation of the return is 25. Average return of the market is 11. Standard deviation of market risk-free rate RF is 4. What is the Sharpe ratio? In fact, the same question was repeated. Even the numbers were same in the last paper. So even such things happen that the exact question was repeated in the future exam. Okay, so Sharpe ratio, returns of portfolio minus, so 15 minus 4 upon standard deviation of the return is 25. So answer is B, 0.44. Finished. Sharpe ratio, easy, done. Next question. A bond of a company with a face value of 1000 provides 12% annual return, that is a coupon rate is 12, and pays 1050 at maturity, which is 10 years. Investor required rate, expected rate R is 13. What should be the price of the bond? Okay, simple again. So price of the bond is equal to, so 1000 is the face value, par value, 12% is annually, so 120 into PVIFA, 13%, 10 years, plus on maturity you are going to get 1050 into PVIF, 13% and 10th year. Okay, so 120 multiplied by 13%, 10 years, 1.13. Okay, so it is 5.4262 plus 1050 into 10th year, 0.2945. Okay, so 120 into 5.4262 and 1050 multiplied by 0.2945. So value of the bond 960. Okay, value of the bond is 960. There is some rounding off error obviously, so correct answer 960.87. So due to rounding off, your answer will be 960.5, 960.4, 960.6. Okay, so the closest answer is option C, that is 960.87. So easy question on bonds. Next question. An investor buys 100 shares, okay, at rupees 210 per share. At the same time writes, okay, writes a September call option, so call writer, at a premium of 20 rupees. If the actual price, expiration is actual price is 280, calculate the profit or loss. Okay, so here what the investor has done is, there are two things he has done. He has bought the shares in the cash market. So in the cash market, he is long position. He has bought the shares, and what he has done is he has written a call option. So you have to do for both, because on one hand he is taking a bullish stand. On the other hand, he is taking a bearish stand because he doesn't know the actual price, what is going to happen. So he wants to hedge. This is what he has done, is a hedging strategy between cash market and options market. So let us see what will happen. So first we'll see in the cash market. Okay. So what cash market he has done? He has purchased the share. He has bought the shares, 100 shares, okay, at a price of 210. So his purchase price is 210. Okay. Then at expiry, what happened to the market price? The market price at expiry is 280. So he purchased the share at 210 and now the price has gone up to 280, which is a good thing, and therefore there is a gain. Simple common sense. It is a gain of 70 rupees per share. You buy a share at 210, now the price is 280. Obviously there is a profit of 70 rupees. This is in the cash market. Now what happened in the options market? In the options market, he has written, that means he is a call writer. He is a call writer and he writes a call option September at 250. So what is the strike price? Is rupees 250. So strike price of 250 and he is a call writer. That means what is done? He has promised to sell at 250. And the actual expiry price, okay, actual expiry price is same, that is 280. So see, there in a call option, one is the call buyer. So call buyer, who is a call buyer? He has right to buy. Okay, call buyer is right to buy the stock. Opposite is call writer. He has obligation to sell. One is right to buy. Okay, opposite is obligation to sell, and the price has gone up and therefore he will incur a loss. The other party will exercise and therefore this our investor will incur a loss of 30 rupees. But since he is a call writer, he receives premium. A call buyer pays a premium. A call writer receives premium. And therefore, he has received a premium of 20 rupees. And therefore, he has a loss. So, loss of 30 plus positive 20. So, difference is loss of rupees 10. And now they are asking what is the net position. So, on this side, there is a gain of 70. On this side, there is a loss of 10. So, what is the net position? Net position is 70 positive minus 10 loss. And therefore, final answer is option A. In the cash market, he was positive 70. In the option market, he was negative 10. So, he wanted to hedge. See, if the price would have fallen down, okay, then his losses would have been protected. But here also, if you observe, net combining both, he is still earning a net gain of 60 rupees. So this is an example of hedging using options. Okay, next question. So what is the next question saying? A buy signal. Now it's a direct question, theory concept based question. A buy signal provided by a moving average analysis of stock price is when the stock price line. Now see, moving averages is also a technical indicator. Okay, so there is a share price line and there is a moving average line. Okay, now see what happens. I'll explain it to you with a diagram. Now, Let us understand. So suppose, okay, suppose this is my share price line in red color. This is my share price line, and in blue color, this is my moving average line. Okay, suppose let's write down. This is moving average MA, and this is my stock price SP, for example. So now what does this mean? My stock price is above the average. Okay, I'm just explaining the concept in short. So the average price, for example, if average price should have been 70 rupees and my actual price is 90, that means the stock is on a higher level. So when the actual price is higher than the average line, we say it is a bullish indication. So bullish means the market is likely to go up. Positive sign, bullish. That is the concept. Okay? The basic concept. Now what happens is, okay, let us see now what happens. Okay, so this is my moving average line. Now, if my stock line is coming from up and it cuts it here, my share price line will cut the moving average from above. See, earlier what was the indication? It was bullish, but now it has cut the moving average and now it is coming down. So what does it mean? This means it's a bearish signal. It means it's a bearish signal because earlier it was above, it was positive, average line was below. But now from above, it is coming down. So the market price is coming down. That is a bearish signal. Okay, this is first example. Just to understand the concept. Let us take second example. So this is my stock price line. And the blue one is the moving average line. So now what happens is, see the diagram, my stock price line is below. Average price should have been 100, but my actual price is 80. So it is a low confidence, it is bearish. But now what is happening here? See, my stock price line, which was earlier bearish, it has started to go up and it has cut the moving average line from below. It is going up now. So it is going up. So this is a buy signal. So when it starts to go up, it is called as a buy signal. That is the concept. Now what the question is saying, a buy signal provided by the moving average analysis of a stock price is when the stock price, see the word, when the stock price, okay, now you will be able to answer just looking at the diagram. When the stock price rises, yeah, stock price, see the diagram, stock price rises above the falling, the moving average is coming down, falling moving average line. So the diagram is very clear what is happening. So if you know the concept, then answer is easy. So I've explained the concept of moving average as well as the answer. Next, in contrast to a CAPM, that is capital asset pricing model, the arbitrage pricing theory. So both are slightly connected to each other. So CAPM is much earlier, okay, given by Sharp and Trainer and Jack Mossin and Lindner, and arbitrage Stephen Ross came much later. So they are asking what in contrast. So what is the difference between the two? How they are different? So in contrast to CAPM, the arbitrage pricing theory requires that the market must be in equilibrium. Okay. It uses risk premiums based on micro variables. This is definitely a no, because arbitrage pricing theory, they uses macro variables. So actually they use macro. Okay, they don't use micro. So this statement is not valid. It specifies the number and identifies the specific factors that determine the expected returns. Okay. requires the market to be in equilibrium, okay, and does not require the restrictive assumptions concerning the market portfolio. So considering all these points, in contrast, the arbitrage requires in equilibrium, no, specifies that no. So correct answer is the APT does not require. See, all the other things doesn't apply. So correct answer is option D. So this is purely a theory. If you know the theory, you get the answer. If you don't know the theory, then just भगवान का नाम लो और टिक करके आगे जाओ. Next question. The expected return on the portfolio is 17% and the variance and investors utility are given. So this utility concept they are asking again and again. It's a part of your portfolio analysis. What will be the risk tolerance? Now this time they are asking you. In one of the questions exams they had asked find utility. In one of the papers they had said find penalty. And now in this they are asking find risk tolerance. So let us go backward. So utility is equal to expected returns minus risk penalty. So utility is given, that is 12, expected returns are 17 minus penalty. Okay, so substituting the value, so we get the answer of the risk penalty. So first answer we got risk penalty is 5. Okay, risk penalty, this is 12%, this is 17%, so risk penalty is 5%. First answer got. And now second thing is, what is formula of risk penalty? Formula of risk penalty is variance, that is square upon tolerance, and therefore the information is given. So risk penalty we found out, which is 5, is 5%. Variance is given, that is 300 percentage square, this is given. So what will be tolerance? 300 divided by 5. Okay, in the equation this is 5, this is 300, so 300 divided by 5, the correct answer of risk tolerance is 60. So again, purely you know the formula, you know the concept, and then you get the answers. So correct answer of tolerance here is 60. Next question. Next question is based on forex. The spot rate is given so and so dollar per rupee. 6-month forward rate is given, again dollar per rupee. The normal rate of India 6 months is 6% per annum. What would be the normal rate in USA? So this is based on the concept of interest rate parity, because you are given spot rate, forward rate, and they are talking of interest rates. So relation of interest rate and forex rate is given by IRP. Okay, so we have to find out this rate. So there is a direct formula given for IRP. So we put the formula and then we get the answer. Okay, so let us solve. Okay, so based on the information, let us see how to get it done. Yes, so in this question we have to make an assumption. Now they have not given as such that are we in the USA or are we in India, because based on the assumption, okay, the direct quote or indirect quote will be decided, and then accordingly the formula will be decided. Okay, so now what we'll do is, let's go to US. So if we assume that USA is the home country, okay, if we assume that USA is the home country, in that case what is the formula? 1 plus RD upon 1 plus RF is equal to forward rate upon spot rate. Okay, assuming that we are in the US, so what is the rates given? So 1 rupee, this is how the rates are given. 1 rupee is equal to, so from the USA point of view, these will be direct quotes. Okay, from the US point of view, these will be direct quotes. So what is the RD? RD is interest rate in domestic market. So domestic is own market. So what is the rate in USA? Okay, and then what is the rate in India? So India will be foreign market. So India rate is given, that is 6%, and USA we have to find out. Okay, so 1 plus USA we don't know, so I'm just assuming X. This is per annum, but duration is 6 months, so into 6 by 12. Upon India, it is 6% per annum into 6 months, so 6 by 12 upon forward rate. So forward rate is 0.01190 upon spot rate 0.01182. That's how the equation will be created. So X, we don't know, X into 6 by 12 is 0.5. So numerator is 1 plus 0.50x upon 6%, so 1.03 is equal to 0.01190 upon 0.01182. So when solving the equation, we get the value of x. The value of x comes to 0.7395. Okay, and since it's a percentage, you multiply by 100, so approximately 7.40%. This is the value of x, and x is what? X is the rate in USA, domestic country, 7.40. So let us see, do we have 7.40? Yes, we do have. So option is A. 7.40 is the rate in domestic, that is US, for example. In this case, US. Okay, next question, theory question. Okay, so theory question is what? Direct answers. You know the answer, 1 minute. Don't know the answer, 1 minute. Which of the following components of digital infra is or are a messengers that process request, ensure seamless functioning of an enterprise system? So they are messengers that process the request. Okay, so whether internet is a general thing. Okay, internet is a general thing, so that is not the answer. Cloud services are storage, so they are not processing request and functioning. Data centers and networks, again no. So the correct answer is application programming interface. Okay, so these are the ones, okay, which interact. The word interface means they interact with each other. So interaction means they are kind of messengers. So they take the data, they forward the data through different systems. So correct answer is API, that is application program interface. That is question number 10. Then question number 11, Sharpe ratio, trainer ratio of funds are given. Then correlation is given, 0.6, standard deviation of the market index. Very less information given. And if you remember, in the last paper we had identified a formula. So that formula we'll be using here. So what was the formula we had identified? The formula we had identified was Sharpe ratio upon trainer ratio is equal to beta of the portfolio upon standard deviation of portfolio. So in this, the data is so less that we have to use this formula. Sometimes the questions are so easy that you directly put the basic formula and you get the answer. But sometimes they will put some complex questions wherein we have to do some complex calculations. So let us use this in the question. So let us see what all information given. So Sharpe ratio upon trainer. See, your RP minus RF is common. That's why they get cancelled. So why this formula comes? Because since RP and RP minus RF is common, so they get cancelled, and therefore this is what remains. So in this question, what is Sharpe ratio given? Sharpe ratio is 0.35, and what is trainer ratio given? Trainer ratio is 6.5 is equal to beta upon standard deviation. So if you do 0.35 divided by 6.50, so it comes to 0.0538. So solving this, we get beta is equal to 0.0538 standard deviation. Okay, solving this equation, we get this value, we get these relationships, I will say. But then beta has a normal formula, standard deviation of portfolio upon standard deviation of market into R. They have given the value of R. You see the question, they have given the value of R, that is 0.6, and standard deviation of market is needed. So we want sigma m. Okay, sigma m we want. So now what I'm going to do is I'm going to substitute. So this beta LHS is same, so I'll substitute here. Therefore 0.0538 sigma is equal to sigma upon, this is portfolio into R, and R value is given 0.60. So now if you observe, these two will get cancelled, this and this, sigma p, they will get cancelled, and what remains is standard deviation of the market. So if you again solve the equation, so standard deviation of the market will be, okay, this will go on the other side, so 0.6 divided by 0.0538. So 6 divided by this, so answer is 11.132 approximately percent. So let us see whether this answer is anywhere in our options. 11.13. Yes, we have a very close substitute. Answer is 11.14. That is the right answer. So again, kind of we had to go around the formulas, design some new formula, and then get the answer. So the formula is on the screen. So when the data is insufficient, then you can use this shortcut and then try to find the answer. When data is insufficient, when everything is ready, everything is served to you on a platter, then you go straight. When the things get complicated, then you use this formula to get to the answer. The next question now it's a theory question. Which of the following statement is true concerning the three forms of efficiency? So again, this theory has been asked again and again. Efficient market hypothesis. We have discussed this. Weak form is based on past information. Semi-strong form is present published information. And strong form is based on unpublished secret information. So what they are asking, equilibrium rate of return will prevail. Securities of the firm sell at their fair value. Investor cannot earn a positive return. So which of them is true based on the efficient market theory? So investors cannot earn a positive return. Okay. Securities sell at their fair value. And equilibrium rate of return will prevail. So sometimes what happens, even if you know the theory, the options are something completely different. So again, we have to apply ourselves what might be the answers. Okay. So which of the following are true for all the three forms? Okay, all the three. Now we got the important word. It is true means it is correct for all three. Now this investors cannot earn a positive return. this happens only for strong form of efficiency. This doesn't apply for weak and this. So obviously this answer is not applicable because it doesn't apply to all three. And security of firms select their fair value, yes, and equilibrium rate will prevail, these are common. So 1 and 2 are fine. So answer is option D. Both 1 and 2 are valid for all the three forms. The third one was only for the strong. It doesn't apply to weak and semi-strong. So sometimes even the known topics can cause some headache, some confusions. That is what they did in this question. Okay, institute is very smart. Then change closing prices are given for the stocks, and what would be the RSI? Now, if you are with me from the very beginning, okay, so this question was asked as it is in 2022 or 23, one of the papers, as it is, same numbers. And RSI, so RSI is relative strength index. So relative strength, the actual thing what we do is we take the differences, that is the real stuff. The real stuff is to take the difference in prices to know whether it is up and down. But the options are such that that will not work here. So from 125 to 135, price has gone up. 135 to 132, price has gone down. 132 to 142, price has gone up. And 142 to 145, the price has gone up. And therefore relative strength is equal to average of up prices upon average of down prices. Actually we have to take the difference of the two in the real stuff, but here they are giving even more basic. So average of ups, so 135.25 plus 142.75 plus 145.25, so average, so 3 days, so upon 3, and the downside is only on 1 day, so average will be same 132.75. So when we solve the equation, so this upon 3 upon this, the answer comes to 1.06. So correct answer is option C, 1.0628. This is one of the, I'll say, crude method of finding relative strength. Then next is Greeks, option Greeks. We have done them many times. Which one of the following option Greek is respect to measuring the sensitivity of option price with respect to volatility? V. Easy to remember. V for volatility, V for Vega. End of the answer. Finished. T for time value, T for theta. Finished. So few are just the alphabets you match. So time to expiry T, theta. Volatility V, Vega. Easy. And interest rate R, rate for R, rho. Easy. And then remaining is simple delta. And delta gamma are related. Prices with underlying asset. Okay, so easy to remember that here the word is volatility starts with V, answer also starts with V, Vega. Time to expiry starts with T, theta. Interest rate R, rho. So match the alphabets and match the answers. So direct answer. And the 15th one, a portfolio holding 90% of its assets in nifty stocks in proportion to the market value and 10% in the treasury bills are more sensitive to. Now again it's a direct question, theory part, that a portfolio has 90% connected to nifty stocks. So nifty means the basket of 50, and only 10% are linked to treasury, that is debt. So it is more sensitive to. So option 1 index, option 2 systematic risk, option 3 unsystematic, and option 4 none of the above. So now the common sense answer would be obviously if 90% are connected to nifty, and Nifty is a type of index. So the common sense answer would be A, index. But 10% are also related to treasury bills. So treasury bills and Nifty is the overall market. Okay, Nifty is representing the market, and market which is affected is called as market risk. And what is market risk? Market risk is nothing but systematic risk. So index risk would be a right answer, but systematic risk would be a better answer, because index is a part of systematic, and therefore the right answer here would be B, that is systematic risk. Okay, so with that we have finished with the June 2025 paper, and now the last paper remaining, that is December 2025. So let's start with that. Okay, so now we go to the next paper, that is the December of 2025. Okay, chalo, so let us start question number 1. The profitability index, that is PI, of a project is 2 times when the annual cash after tax cash inflows commencing from second year to fourth year of 400 lakh each. So year 1, okay, it is not there. So year 2, year 3, year 4. So 3 years, it is 400 lakh is discounted at 10% rate. How much would be the initial cash outlay? What will be the investment? That is the question. Okay, and they have given the PVIFA for every year, first year, but we don't want this. Why? The inflows are from second year, third year and fourth year. So you want these 3 numbers. So if you want to take the total, so 0.826 plus 751 plus 683. So if we want the total of this, that is 2.26. We want this total of second year, third year and fourth year. Okay. And okay, now the things are straightforward. Once we have this information, we will use it to find. So what is formula of PI? So formula of PI is present value of inflows upon present value of outflows. So outflows means here our investment. So PI is 2 times and present value of inflows. So inflows every year are 400 lakh into PVIFA, present values, upon investment. This is what we want. We want the investment. And therefore, twice our investment is equal to 400 into present value. We already calculated 2.26. Okay, so 2.26 into 400 and 2 on this side, and therefore the investment, that is initial cash outflow, comes to 452. Solving the equation, let us see whether we have 452. The answer is yes, option B. So option D is 452 lakh. Simple. So just put the formula. Important thing is the wording from 2 to 4. And therefore we ignored the first year present value factor. We only considered the second year, third year and fourth year. Okay. That is question number 1. Now coming to question number 2. The following information is available with a project. So project cost 12,000, annual cash, everything is given. The sensitivity, okay, with respect to project cost. So meaning of sensitivity is that what will be the change in the variables so that the NPV becomes 0. So variables means we check the change in project cost, we check the change in inflows, we check the change in rate, number of years, so individually. one change at a time. That is sensitivity analysis. So because we want the change in NPV, so first we have to find the NPV. So let us quickly find the NPV. So NPV is your cash inflows. So the cash inflows are 4,500, okay, into PVIFA 2.9137 minus project cost, that is outflows, that is 12,000. So 4,500 into 2.9137 minus 12,000, and therefore my NPV is 1,111.65 is the NPV. Okay. And now they want us to find out the sensitivity with respect to project cost. So answer is very simple. The formula, so sensitivity is equal to NPV upon project cost into 100. So NPV 1111.65 upon project cost is 12,000 into 100% for percentage into 100. So answer is 9.26. So do we have 9.26? Yes, we have. Yes, we have. So answer is 9.26 is the sensitivity of NPV with respect to project cost. Finished. MCQ 2 minutes. Means I am solving slowly so that all of you understand. But once you understand, you will solve quickly. You will not even take 2 minutes. I am confident of that. Okay, next question. The following information is available: expected cash flows and probability. So 10,000 probability of 0.7, 20,000 probability of 0.3, and amount in lieu of expected cash. Matlab, this is the certain cash flows. See, 20,000 is big but uncertain. 12,000 is less but certain. And what they was find out? We have to find out CEC, certainty equivalent coefficient. That is what we have to find out. So first of all, we find out the uncertain. So they have given the table, so easy. 10,000 into 0.7, that is 7,000, and 20,000 into 0.3, that is 6,000. So total uncertain is 13,000. So what is the formula of CEC? So CEC is equal to certain cash flows upon uncertain cash flows. So certain are 12,000 upon uncertain are 13,000. That's it. It's as simple as that. So 12 divided by 13. So answer is 0.92. So answer is in front of you. 0.92. Option C. Option C. Finished. Again, matter of 1 or 2 minutes. Next, now it's a theory question. Again, if you know, you know. If you don't know, if you have not done the theory, then it's just a fluke. It's just a luck factor. So let's see. Under securitization process, dash are instruments which are issued by a subsidiary company in respect of the receivables of a holding company. Now, when you see the options, pass through security, pay through, correct? All of them are instruments. All of them are instruments used under securitization, but what they want is, they want instruments issued by subsidiary. They are specific. The question is, they have designed the questions of small, minute places. They have picked up the questions on digital finance and securitization. So there are pass through, yes. There is pay through, yes. But where subsidiary and parent are involved, the correct answer is preferred stock certificates. I know that the moment you see this question, you are going to open the module, your notes, and you will find there that yes, subsidiary word is there only for preferred stock certificates. That is the answer. That's why I said if you read it, you remember it, it's few seconds. Okay. Next question. 100-day stochastic. So stochastic comes again. In the last paper also it was asked, and find the value of K. We discussed in the last paper what exactly the concept of stochastic is. It is a technical indicator to identify overvalued and undervalued stocks. So the formula of K, okay, formula of K is closing price minus low price upon high price minus low price. So what is the closing price? 210 minus low price is 200 upon high price is 240 minus low price is 200. So this is 10, this is 40. So 10 upon 40 percentage 25% into 100. So finally the answer comes into 100. So the answer is 25%. So just know the formula. That's it. Know the formula, get the answer. Next question. Bond valuation. So company has 1 million AAA rated 12% bonds. So that is the coupon rate. Maturing in 7 years from now, the market interest rate R is 14%. The price of the bond will be, again simple, price of the bond. All the present value factors are given to us. Okay, all the factors. So face value 100, so 12%. So 12 into PVIFA, 7 years. But which rate? 12 or 14? 12 or 14? It is R. R is 14. So 14%. So you consider this value into 4.288 plus maturity value. Anything else given? Any premium? Okay, nothing given. So maturity value is 100, and again 14% PVIF, 14%. So 0.400. So 12 into 4.288. 12 multiplied by 4.288, whatever the answer, plus the maturity, that is 91.46. It is in front of us. Option B, 91.46. Done. Chalo, next question. See, simple bond valuation, no complication, direct answer. Next question. Oh, tired. A prospective investor has collected the following information pertaining to two securities. So gilt-edged returns. Gilt-edged is generally safer. So returns are 7%. Okay. So returns of this security are 7. Standard deviation, because it is safe, government, so 0. 0 risk. Equity 25%. Standard deviation of 30. Using the above two securities, if the investor is planning to invest 5 lakh in both of them, construct a portfolio with a standard deviation, that is risk, of 24. Then what will be the return of such portfolio? What will be the return? So standard deviation is given 24. So standard deviation means the risk of the portfolio. And to find the risk of portfolio, we must know the weightage of two investments. The weightage is not given. Means what is the weightage of gilt edge and equity? That ratio is not given. But we can find out. We can find out. Let us see now. Let us solve. So what we have to find out? The standard deviation of portfolio, which is given, and this is nothing but the weighted average of both investments. That is the basic formula. And this is given 24. This is given 24, and weightage of 1 into standard deviation of 1 plus weightage of second one into standard deviation of second one. That is the formula. So 24 is equal to, first is gilt edged. So gilt edged, the weightage is don't know. That is what we are trying to find out. But risk of that is 0. plus second one is equity and risk of equity is 30. Simple. Risk is standard deviation. See here. This risk of is 0 and risk is 30 standard deviation that we are taking. And therefore the first one will be 0 obviously, plus 30 into weightage of second one. So solving the equation, weightage of second one is 24 upon 30, that is 0.8, that is 80%. So 80% is into equity and therefore remaining 20% is into gilt. So we got the ratio, that is debt is 20, gilt and equity is 80. So once we get the ratio, now the answer is easy. Okay. So what are the returns? Returns are 25% and 7%. Okay, 25 and 7. So I'll continue here now. So returns of portfolio, okay, returns of portfolio is 7 into 20%, that is the weightage of debt, plus 25 into 80%, that is the weightage of equity. Let us solve this. So 7 into 20%, that is 1.4, 25 into 80%, that is 20 plus 1.4. So overall returns are 21.40%. Overall returns. And what is overall investment? Overall investment is 5 lakh. And therefore returns in rupees is 5 lakh, which is the investment amount, multiplied by 21.4%. So 5 lakh into 21.4%, that is your returns, that is 1,07,000. So 1,07,000, we have option B. So this was not a straightforward question, but once you see this, you will realize it's not even a tough question. It's a slightly longer, you have to think more, but it's not that difficult as such. Okay, so first what we did, first using the given information, we first found out the weightage. So once we got the weightage with the help of standard deviations, then what we did, we found out the returns and then finally the amount. So it's a long process for 2 marks, I understand, but yes, it is worth doing because every mark counts. And especially, see, sometimes it is easy but long, you do it. Maybe you keep it at the end, but you do it. Next question. Okay, next question now. Chale. Company is entirely financed by equity. The equity share has a beta of 0.8. The company pays no taxes. They decide to buy back half of the equity and the buyback will be financed by borrowing. Okay. If the debt yields a risk-free return of 10% and debt has 0 beta, what will be the beta of equity after buyback? After buyback. Okay, so something which is different, never asked. So overall beta, let us take one formula. Okay, overall beta is equal to beta of equity into weightage, because now originally there was only equity, but now there is equity and debt, plus beta of debt into weightage of debt, because now the combination has changed. So earlier 100% everything was equity, but now the weightage of equity is half, 50-50. It is given here that buyback half. Okay, and therefore originally the beta was entirely of the company, which is 0.8. Now beta of equity we have to find out. Weightage we know 50%, plus beta of debt is given 0. Debt has no risk, into weightage 50%, and therefore 0.8 is equal to 0.5 beta of equity. Okay, zero point 0.8 is equal to 0.5. So 0.8, simple calculation, 0.8 divided by 0.5. So answer is 1.60. So option A, 1.60 will be the beta of equity. So now see, originally they were just equity, so entire equity was company. Okay, but now equity has become half because of the buyback. So automatically the beta will be adjusted. That is the answer. Now next question is a direct question. Which of the following types of credit risk is a chance that a rating agency will lower its rating on the issuer, or the probability of loss from the fall in the rating because of, see the wording, deterioration in the financial condition. So credit rating is an ongoing process. At the time of issue they give a rating, and then every year they judge, every year they measure, and they give their opinion that earlier the financial condition was good, stable, whatever, and every year it may go up, it may go down. Here the wording is lower. Okay, lower, so it has gone down because of deterioration in the financial condition. And it's not bad debts, it's not winding up, it's not insolvency, purely company's own condition. So nothing to do with country. Okay, nothing to do with default. So when this regular, periodic, lower, it is called as downgrade risk. So remember this word, that whenever the credit rating agency reduces the rating based on the day-to-day normal working, okay, it's a regular, annual, periodic phenomenon. It happens every year. So it's called as downgrade risk. Okay, next question. Consider a bull spread using a call option. Earlier twice they had asked this question, and what all information is given, let us see. 220 exercise price, premium 24. Second exercise price is 280, premium is 14. Current market price today spot is 248, and the price at maturity or expiry has become 360. What will be the profit? There are two strategies. Let us do it again. Last time also we had done. Let us solve again. So bull call spread. So bull spread strategy. So what we do is we buy a call option. Okay, we buy a call option in ITM, in the money. At the same time, we sell a call option that will be OTM, out of the money. So the premiums will be different. Okay. So what is the meaning of ITM? The ITM will be a lower strike price, lower than today's price, and OTM is higher strike price as compared to today's spot price. So what is today's price? The current market price is given as 248, and there are two values, 220 less than and 280 more than. So this is less than. So here exercise price or strike price. So I use the word strike price because we have used it earlier. So in this case the strike price will be 220, and in this case the strike price is higher than market. So this will be 280. This will be 280. Then the actual price at expiry, is given, that is 360. 360 expiry 360. Okay, so now obviously we wanted the price to rise. So our strike price is 220 and we wanted the price to rise. It has gone up, and therefore in this case we will exercise the option and we will have a gain. The differential gain is 140. But because we have bought a call option, we have to pay a premium. So what is the premium on 220 exercise price? the premium is 24. So what is the net effect? Okay, 140 minus 24, the net effect is 116 positive, gain of 116 on this side. Now on the other side, we had sold a call option, so the other party will have a choice. So again the other party will also exercise and we will have a loss. So 280 minus 360. So we have to buy at 360 and sell at 280, and therefore we will have a loss of 80. But since we are a writer of an option, we have received premium. So how much premium we have received here? 14 rupees. So we have received 14 rupees here, and therefore there is a net loss. There is a net loss of 66. So this is minus and this is plus. So one is minus, one is plus, and therefore minus 66 plus 116. Okay, these two together, the net effect is 50 positive, option C, 50 positive. So the whole question is here. See, this can be even a 7 marks question, because if you know, you know. 2 marks, it is a lot of work, but yes, we have to solve it. That is bull spread using call options. So question number 11. Again a theory question, you know, you know. Which of the following complex financial derivatives are options having a maturity of 3 years? So correct answer is leaps. Because see, warrants generally are up to 1 year. Swaptions again different. Baskets again 1, 2. So again, if you read the theory, leaps are the only one. It's clearly mentioned in the module that it goes up to 3 years. That is the question again, up to 3 years leaps. The next also is a theory question. What are they saying? That which of the following are features of GDR? Features of global depository receipts. The returns are good for the foreign investors and they are globally marketed. So correct answer is C. Correct answer C, because GDR are listed in the foreign markets, so globally marketed, and the returns are also better for the foreign investors. So answer is both of them, A and B. Done. Okay. The actual exchange rates. Next question on Forex. Actual exchange rates are given below. And what will be the cross rates between euro and rupees? Okay, now let us see what they have given. So first 1 euro. Okay, first they have given 1 euro is equal to dollar 1.1201, 1.1216. Okay, so euro to dollar, 1 euro. And second they have given is 1 rupee is equal to dollar again 0.0116, 0.0118. These are the given information. So actual exchange rates are available. Euro USD 1 euro. Okay, so euro is kept as 1, so we call it as a direct quote. So in the direct quote, the lower is the buying rate, this is the buying rate, and higher is the selling rate, this is the selling rate. Okay, and 1 rupee is equal to dollar. So if you consider India, it is an indirect quote, and in indirect quote, what is the rule? Indirect quote is buy high. So here this is the buying rate, buy high, and this is the selling rate, means ask rate. Selling rate means ask rate, bid rate and ask rate. Okay, I'll use the word ask. Okay, let us not have the confusion. So when I'm using the word selling rate, what I mean is ask rate. B is the bid rate or the buying rate, and this is the ask rate. So for direct quote, the rule is buy low, bid low, ask high. For indirect quote, it is opposite because they are reciprocal. So for indirect quote, it is buy high, that is bid high, ask low. And now what they want us to find out, what will be the cross rate between euro and rupees. Okay, they want to find out the cross rate, that is this. Is equal to this upon this multiplied by dollar upon rupee. So first, pound upon dollar, sorry, euro, again my bad, euro. So euro upon dollar is straight away given here, euro upon dollar, that is 1.1201. Okay, bid rate. And what is the bid rate here? So you have to find a bid to bid finally. If your cross rate you are doing, so bid will be compared with bid. So 1.1201 multiplied by pound goes up, rupee comes down, so 1 upon 1.0118. So this comes to 94.9237. And the second is ask rate, so 1.1216 into 1 upon 0.0116. So this comes to 96.6896. So correct answer is option A. So what is the tricky part here? The tricky part is identifying the direct indirect quotes and identifying, okay, in direct quote the bid rate is low, ask rate is high. In indirect quote the bid rate is high, the ask rate is low, and when you are doing the cross rates, then bid compare with bid, ask rate compare with ask rate. That is what is needed, and that is how the calculations are done. And now the next question, a theory one. Okay, next question is theory. Dash explain the relation between inflation and spot rate, that is exchange rate. Okay, it cannot be easier than this, purchasing power parity, because inflation measures the purchasing power of money and purchasing power with respect to exchange rates. So PPP theory, direct answer, not even 10 seconds. And the next one, which of the following examples of cryptocurrency takes its name from a internet meme? Shibu Inu dog. Okay, internet memes, Shibu Inu dog. So from this, obviously, the dog coin. Okay, the dog coin is created. It is named after this internet meme. So that is question 15, and that is it. So MCQs are done for the December exam as well. Okay, so now we have covered all the MCQs of the last 9 exams from 2022 till the last exam, that is December 2025. So 9 exams, each and every MCQ we have solved with explanation, with step by step, in a nice, organized, comfortable, convenient, understandable manner. Okay, so I hope all of you have understood, all of you will learn, and all of you will have a better confidence in solving MCQs and getting the maximum marks. So this is your ranker friend CS CMA Prasad Bhat, and again I wish you all the best and score exemption in this coming exam. So thank you and God bless us all.